3 o'clock Eastern Time episode of Fool24. I'm Ron Gross, coming to you from not so sunny Rockville, Maryland today. A little snow in the forecast here, but always happy to join you and to be joined by my buddy over there, Rich Griefner. Hey, Rich.
Hey, Ron. Hi, Fools. My name is Rich Griefner. I'm joining you from the almost always sunny Santa Barbara, California. So, Ron, I'm not sorry to hear about your weather situation.
It was going to be a foot of snow. Now we're down to only about an inch. So I think we might be okay. Fools, we're going to talk value investing for the next hour or so. A reminder that we cannot provide any personalized advice, but we're happy to take as many questions that fall under the banner of value investing, which can mean a lot of different things to different folks. So keep the questions coming in Slido, and we'll get to as many as we can. Rich, I see in Slido from previous hours there are a few questions in the valuation section of Slido.
Oh, great!
So if it's okay with you, while we wait for more to come in, I'm gonna jump on some of the older questions.
Yeah, that sounds good. We can certainly do that. If you have some in mind, let's
let me. The first one that comes to mind is from Ajit Jain, interestingly, who asks, "Do you think Buffett would be buying his own stock at the current valuation?" Very interesting question. Full disclosure: Berkshire is my largest position, has been for a very, very long time. Buffett usually says, Rich, correct me if I'm wrong, that he is a buyer at around 1.1 or 1.2 book value or lower or thereabouts. I believe we're higher than that right now. We're probably 1.6, 1.7 times book. I think we're at over 2 times tangible book value. So I don't think you'll see any meaningful purchases from Berkshire at this price. But don't forget, Berkshire's looking for a bargain. He's a value investor. He has a very strict process that he sticks to, especially with his own company, of which he knows more about than anybody on the planet. So he knows what a good entry price is and perhaps when it isn't. So I would think you won't see any meaningful purchases here. Rich, what do you think?
Yeah, agree. I mean, if anyone should know, it should be Ajit Jain, who runs the insurance operations for Berkshire. You should know better than us if Buffett would be buying his own stock. No, Ron, I agree. I don't think Buffett would be buying Berkshire. In fact, he's not buying too many equities in general. It looks like he's kind of reducing some positions, most notably the banks. So he's building up. You know, they already have so much cash coming in day after day, quarter after quarter. But they're building up some cash, hopefully, for Buffett to be able to put to work at attractive prices.
Yeah, exactly. Maybe we should set the table a little bit while we wait for some questions to come in and just talk some generalities about value investing, because I do think it means different things to different people. So I'll put you on the spot and ask you, what does value investing mean to you, and then I'll take a shot at it as well.
Yeah, I actually have maybe an unconventional definition. I think the conventional definition of value investing is you're looking for a stock that is cheap based on some observable metric, right? So low price to earnings, price to book, cheap relative to what your estimate of replacement cost. I think most people would say ballpark, that's the definition of value investing. I've never really liked that definition. I find it limiting, because if you find a stock that is obviously cheap, it's usually, almost always, it's obviously cheap for a good reason, right? The stock stinks. Yeah. People don't want to own it for a good reason. So I've always preferred Joel Greenblatt's definition of value investing, a value stock, which is really, I want to estimate what a stock is worth and then buy it for much less than that amount. So under that definition, anything can be a value estimate. Just figure out what it's worth and then buy it for much less than that.
Not always an easy thing to do, but
easier said than done.
Yeah, but it's beautiful when you can find it. For me, it's very similar. Obviously, it's also using various valuation tools, and there are many: relative, absolute, discounted cash flows, multiples, ratios, to get a sense of what you think a company is worth, sometimes called the intrinsic value, and then deciding at what price I need to purchase it at to get the rate of return that I'm looking for for the risk associated with that investment. Is it 10%? Is it 12%? Is it 15%? Whatever the number is that I'm looking for out of an investment, and that number might go up the more risky a stock is perceived to be. That's what I think of when I think of a value investing, using valuation tools to help me make buy and then eventually sell decisions as well.
And so that gap between the intrinsic value and the price that you pay, we call that the margin of safety. So the wider, the better.
Because we're all going to make mistakes. And if you think a stock is worth 20 and you buy it for 10 and you were wrong and it's only worth 15, you're still pretty good because you've got that safety.
Yeah, pretty good problem to have.
Yeah, for sure. Let's take a look at see questions. Like Buffett, the 10, Jimbo.
Yeah, I like that one from Jimbo. If you want to do it,
sure. I'll just read it and you can take it. Like Buffett, the tendency is not to buy now. The market is expensive. What do you do in this situation? More specifically, would you buy anything now? And if so, what?
Yeah, you're not wrong. The market is expensive relative to historical figures. Having said that, the market is pretty bonkers right now, where if you define the market as, say, the S&P 500, you've got the top 7 or so companies that are soaring, and the bottom 493 not so much. So there's big bifurcations and dislocations in the market where you've got certain classes of companies that they appear very expensive, but I'm not having a particularly difficult time finding attractive opportunities. And that's true in just about any market. There's always going to be something that's overlooked, something that's out of favor. It doesn't matter whether the market is at, near a 52-week low or a 52-week high. I'm not really looking at the market for cues on whether I should be buying or selling. I just look at, am I able to find an attractive opportunity? And frankly, I don't really care what the market is doing. Ron, I suspect you'll give a similar answer. Are you in the same camp there?
I'm in the same camp, but I do some index investing as well. I'm not just an individual stock investor. So when I think of the 7 stocks that you mentioned in the S&P 500, I also then think about the S&P 500 equal weight index, ticker symbol RSP, as a way to play the broader market and take emphasis away from the Mag 7 that are such a big part of that. Last time I was on, Tom Gardner and I were talking about sometimes having a little bit more cash than other times, and we don't like the word market timing because we don't really believe that market timing is the way to go. But on the margins, there are some times where you can't find as many opportunities as you can in a different environment, and maybe then you actually do have a little bit more cash than you would otherwise. The numbers, the stats say you probably would be fine being fully invested all the time, because the market does obviously go up on average 9-ish% a year over long periods of time. So you're fine, I think, doing that as well. But I think the mistake would be to say, the S&P 500 is at 28 times earnings right now. I don't like it. I'm going to move to cash. Because if you miss the top 5 days a year, your rates of return are going to be very different than what the historical rates of return have been. And you don't want to do that. That's why we don't recommend timing the market. Staying in the market through the bumps, the ups and downs, the 25 times earnings, the 30 times earnings, the 20 times earnings. It's going to even out over time. Stick with great companies when you can. Hold them for long periods of time. Companies that can compound rates of return and continue to grow for years and years and years would be the ideal. Shop in the fish in the waters that Rich and I fish in sometimes, where it's the unloved company or the unknown company, even something that isn't as obvious or isn't in the news every day, and we can talk about some of those as well, Rich.
Yeah, it's interesting that you specifically mentioned the PE ratio there, where 20, 25, 30, and as it gets higher, the stock is looking expensive optically, like I was saying. But just because a stock carries a high PE does not mean that it's expensive. In fact, a stock with a PE of 5 could be overpriced, and a stock with a PE of 50 could be cheap. It depends to what extent does that E, the current period earnings, represent the true normalized earnings power of the business. If you've got something that's got a lot of growth ahead of it, or a lot of margin improvement ahead of it, that deserves a high PE. It could be cheap.
Totally agree. And I would actually just a little caution about what we call relative valuation metrics, which are multiples like PE. As Rich said, in a vacuum, a PE of 20 doesn't tell you that much. You need to compare it to something. Perhaps it would be the PE ratio historically of the company, or the PE ratio of the competition, or even the PE ratio of the S&P 500. But in and of itself, it doesn't tell you that much. If you want a standalone metric to help you understand something like a discounted cash flow, where you're actually using the cash flows of the company to decide what it might be worth under a set of assumptions, that would be an absolute valuation metric that doesn't need as much comparison as something like a PE ratio. I see, Rich, a question from Vihan about turnarounds, specifically mentioning several different companies: Intel, Boston Omaha, AMD, Appian. I don't necessarily have opinions on those specific companies, but we could spend a little time tossing around the concept of turnaround investing.
Yeah, happy to. I mean, to quote Buffett, as we always, the obligatory Buffett quote, he says, turnarounds seldom turn around. And that's true. But what's interesting about this question is a lot of these aren't what I would describe as turnarounds. They're companies whose share price has fallen, but the underlying business is fine. It's just, this people got too excited about this stock in, 2021, and the stock price subsequently fell 80-90%, which is, that's brutal. But the underlying business, that hasn't, declined by 80%. The underlying business is fine. So could these be value investments? Absolutely. But I wouldn't characterize a lot of these as turnaround situations. As far as an actual turnaround, oftentimes you will find value there, but that is, to my way of thinking, that's when you're turning around a business's operations, right? Like the company has been struggling, they implement a new strategy, they change up management, something like that. That is what I would consider a turnaround. It's not just a company whose stock is in the dumps.
Totally agree. And that's kind of where you can get into the concept of value traps, because as you said at the top, Rich, turnarounds don't always turn around. So you have to be careful. At this point, I can almost feel it when you're getting yourself into a trap situation, because you're hoping upon hope, which is not an investment strategy, by the way. Hope is great, but it doesn't really pay the bills. But when you're hoping upon hope that something is going to happen because it's not going well, it's not going well, it's not going well, those often end up being what we call permanent loss of capital investments, which is the scourge of the value investor. So you have to be careful. There are stumbles that companies take that, if you don't think the company is as impaired as maybe the market thinks it is, you can have a contrarian view, which is often associated with value investing, and maybe buy a stock at a relative cheap valuation because you see some steps the company is taking that will right size the business. I like Target as an example. Target has stumbled really since the pandemic, being wrongly merchandised, and some other stumbles as well. They've got a plan. They're executing. It's not necessarily going great yet, but I do believe in the long-term business model of Target, especially as they've moved to same-day delivery and their shipped program, and their curbside program. So that would be one where you say, okay, this stock has stumbled. The market is not a fan of it. The stock's like at 14 times earnings. There you go, the PE ratio again. But relative to like Costco at 57 or 52 times earnings or something like that. So it's relatively cheap. It's relatively cheap for a reason. They're stumbling. They pay you a 3.4% dividend. And if you don't think Target is going anywhere permanently, that's like an interesting kind of turnaround concept for me. Nothing that's too impaired, that's getting, there's plenty of people who are doing restructuring investing and bankruptcy investing, and that's a way to go too. That's difficult for me.
Yeah, I personally try to avoid situations like that. Having said that, nothing's truly off limits. I mean, even the hairiest situation, if you can buy it at a cheap enough price, that gives you that margin of safety that, Ron, that you were mentioning earlier. So I'm not opposed to a really hairy situation, but I typically try to avoid, anything looming on the cusp of bankruptcy. You could make a lot of money there, but you've also got a potential zero.
Yeah, for sure. So that's a little hit on turnarounds. I see a question that we can talk about GARP investing, growth at a reasonable price, and I see in need input. Hey, Rich and Ron, what are some GARP businesses you can think of at this time? Rich, why don't you explain what GARP investing is all about?
So GARP stands for growth at a reasonable price. So you've got a company that's growing at a decent rate. The price is not, what we might consider cheap, but good business. Pay a fair price for it, hold it for a long time, you'll do just fine. I think actually growth at a reasonable price, GARP, describes probably the majority of our foolish offerings, I would say. I mean, most of the Motley Fool recommendations tend to have good growth characteristics, good quality businesses, large addressable markets, good management, sound financials, all the qualities that you would want. Businesses like that, typically carry a reasonable, fair price tag because people want to own those businesses. It makes sense. So if you can find, like, Ron was saying, a high quality business like a Costco, we might disagree on this one. I wouldn't say that their price right now is reasonable. I think Costco is pretty overvalued, but that's the kind of business you can be pretty confident in their future growth. Not a lot of surprises I can think of that's going to disrupt that. If you have the opportunity to pay a reasonable price for such a business and you intend to hold it for a long time, you'll do quite well.
Back to Buffett, I feel like over the years, he's really turned more to buying quality businesses at a reasonable price than he was focused in his earlier days on cigar butt investing or really deep value investing. I think that was a lot of Munger's influence on him, actually, telling him to look for quality at a reasonable price or growth at a reasonable price. And he's done pretty well.
All right, but I need input. People want tickers, people want ideas. So I blathered on about what GARP is. One example I was thinking of, Pinterest. Pinterest is a company I've followed for years. I just like what they're doing. The platform has a lot of value, both for the pinners, the users, and the advertisers. And something I like about Pinterest is they've been very deliberate in monetizing that platform. They're very careful to build value for all the users on both sides of the platform, and only then are they slowly increasing the monetization. And maybe that hasn't happened at the pace that Wall Street might like, but there is a lot of untapped monetization potential in this platform. This is a company I think you can pretty confidently say will grow at attractive rates for the foreseeable future. The price right now, it's not overly cheap, but nor is it expensive. So Pinterest, I think, is kind of that nice middle ground, GARP-y style company.
Agreed. You mentioned Costco and how you don't think it's cheap. Another stock that's a large position of mine, and I would tend to agree it's not cheap. I have not sold it because I think it's a very high quality business, but one would have to question what the rate of return is going forward at this valuation. But that does get us into the latest question by Sadaf. Excuse me if I'm pronouncing that wrong. What is your stock sell criteria as a value investor? It's much the same as my buy criteria, unless, well, there's two few different things. One is if my original investment thesis is busted or no longer applies, and whatever it's been replaced with isn't as exciting to me as the original thesis. And then if there's any moral or ethical issue as well, of course, that's just a personal decision whether to hold on to a stock or not. But when it comes to valuation, it's will this stock, like I just mentioned with Costco, at the current price. Remember, it's only the current price is the only thing that matters. What you bought it at doesn't matter. It's what the price is now and where it's going in the future. So where it is right now, can that provide me with the rate of return I'm looking for out of my investments, commensurate with the risk I'm taking for putting capital into that investment? If the answer is no, then you can sell or at least lower your allocation, lighten your load, reallocate some or all of that capital to something that will give you the rate of return you're looking for. Is that how you think about it, Rich, or additional things?
No, that is how I think about it. I will say selling is the hardest part of this game. I don't think it's that difficult to identify a great company, and it's slightly more difficult, but not so difficult to figure out what you estimate it might be worth. But figuring out when to sell it is really tough. And I would just say I've been working at the Fool for 18 years, and it's a lesson that's just been drilled into me time and time and time again. Is if you find an exceptional company that has great management, strong competitive advantages, great growth prospects, great financials, intelligent capital allocation, all those things, you want to be really careful about selling that. Even if you run your DCF valuation, you say, "Oof, this thing's getting pretty pricey." I mean, I cannot tell you how much money I have cost myself by adhering too much to what my spreadsheet says and not just making the simple decision: is this a great business? Yes. Buy it, sit on your hands, go to the beach. My returns would be so much better if I just bought some of these.
Chipotle back in the day comes to mind, right?
For sure. I own Chipotle. I bought it. I mean, the market cap at which I purchased it is ludicrous. I knew that business really well. I believed in its long-term growth prospects, but the price got just too high relative to my estimate for its future earnings power. And the thing that I didn't count on, so I had a pretty detailed model, and I really knew the business well. Not to toot my own horn, but I feel like I really understood the business. And the thing that I just didn't see coming was the digital ordering. So I figured you could only, the problem with Chipotle was throughput. It was always, you could only fit so many people through the line at one time. And so you figure a lunch hour, people eat there, maybe, the peak period is say 12 to 2. There's only so many people you could physically fit through the line from 12 to 2. Okay, fine. They came up with digital ordering and a second make line. They significantly increased the throughput while their expenses remained relatively fixed. Totally transformed the model. I mean, I did not see that coming. And that's a great example of these wonderful businesses. They have optionality where they can provide you with positive surprises and just exceed even your highest expectations. So again, you want to be really careful about selling one of those. Just, you can take it from me. You could really cost yourself by selling too soon.
I will echo what Rich said. As a value investor, I have sold stocks too soon my whole life. I've tried to stop doing it. Still owning Costco might be a good example.
Yeah.
But I have left lots and lots of money on the table. Now, thankfully, don't worry about me. I'm fine. But we have both left lots of money on the table by selling too quickly, adhering too much to a spreadsheet, which is filled with assumptions that you may or not have gotten correct. And the optionality, our friends over at Rule Breakers, and really originally from David Gardner, can see those options and the future so nicely. I'm not that good at it, quite frankly. I'm more here and now, and I struggle with optionality. But it's such an important part of investing where you can eke out years worth of returns in addition to what you think your spreadsheet says. So if you're going to adhere to valuation investing, valuation based investing, just keep an eye on I think it's a common refrain from value investors that they sell too soon.
Oh, for sure, and buy too early. But so we've addressed selling from a quantitative standpoint, but there's also the qualitative life quality standpoint where if you are lucky enough to own one of these big winners, you can find yourself in a good problem to have, where the stock just grows into an outsized percentage of your personal portfolio, and you might feel uncomfortable with that. So the advice that we tend to give is, every investor has to make their own sell decisions, but you should have no single position should be causing you stress and adversely impacting your ability to sleep at night.
Totally agree. And just building on the sell conversation, Sadaf asks, do value investors sell stock immediately when the stock exceeds the fair value range? I think some may. I think that is a mistake I have made. Without getting too much in the weeds, I will just say that when a stock becomes fair valued, depending on your model, it still can theoretically grow probably 10% a year, even after that. That's just the way models work. So you would be leaving that 10% on the table. That's about a market rate of return. So you're not going to be knocking the cover off the ball at 10%, but it's still a healthy rate of return. And if all your investments did that, you'd probably be fine over long periods of time. So I wait until valuations nicely exceed my fair value estimate, because then I'm only maybe earning 5 or 6% going forward. And that's not a market beating rate of return. And I could probably do better elsewhere.
Yeah.
Your thoughts similar?
Yeah, no, totally agree. Nothing to add here.
Okay. Sounds great. Oh, Jimbo wants to know what service you've been working on, Rich.
Yeah, I work on a service called Value Hunters. I've been on that for the past 2 years or so. So come by, check us out. We're putting these value investing principles in practice.
And doing quite well. I will toot your own horn for you. But let's spend a minute on that, because some of the stocks you found, I bet most people have not heard of. To take us through maybe the process of how you uncover a company that isn't in the news every day, and it isn't kind of something that's on the tip of our tongues.
Yeah, I wish I had a process. The ideas just come to you. If you're to be successful at investing, I think you just have to be curious and just pull on threads, and one thread leads to another. And you research, if you research 10 companies, maybe you'll find something interesting. If you research 100 companies, you're for sure going to find something interesting. And then you just follow the thread. You find an interesting company. We've talked about Costco a bunch. You study Costco, you learn about the business, you run a valuation, say, I can't get comfortable at this price. No offense, Ron, but I don't like the prospects of earning a super normal return from here. But in the process of researching Costco, you find something else. There's a competitor, there's a supplier. There, one member of their board of directors also serves on another company's board. Oh, that's interesting. Let me learn about this company. And you eventually, if you just keep working, you will just stumble your way into something interesting that not a lot of people are clued into. I wish I had a better way to explain my process is ABC. It isn't. I fall onto ideas, and I'm naturally curious, and that leads me to attractive situations.
That's interesting. The traditional screening won't always find you the companies that you're finding over at Value Hunters.
Well, I'll tell you, Ron and I used to work eons ago on a service called Deep Value. This is probably the 2010 timeframe, Ron. And back then, you could run a screen, and it was effective. You could just run a screen for statistically cheap companies, and it would spit out 10, 20, 50 opportunities. And you could go through, and in that list of companies, you could find something really compelling. And I don't know what it is, if it's just more and more savvy investor, it's probably, algorithms just scanning everything. But the screens have dried up for me, at least, where now if you run a screen, you find something that is statistically cheap. I just find it is almost always overwhelmingly, there's a reason why it's cheap. This list has already been combed over. The good stuff has been plucked out, and you are left with the husks.
You know what? I'm starting to use AI prompting in place of screening, traditional screening, because you can get a little. It's different than just looking at quantitative metrics.
Yes.
Is it EBITDA under 8 or not, or whatever it is. You can search through qualitative and quantitative data, and it may not be a winner every time, but it can give you places to look, ideas that you can then go ahead and research, and until you find that diamond in the rough. So it's in its relative infancy, the prompting replacing screening, but I think it's exciting.
Yeah, for sure. So Ron, can you give an example of like a qualitative variable that you might layer on top of a quantitative screen?
It could be something, management change. What companies have recently undergone a management shift, but still have a return on invested capital of 15% or higher, but margins have recently dipped. I mean, you could make up literally anything. What industries have had a new competitor recently come in to steal market share? What companies have been in trouble from a market share perspective recently? I guess that would be considered quantitative, but sometimes that data is not necessarily readily available from an SEC document. You have to pour through lots of other type of news items to kind of uncover that. AI tooling can help you get there.
I like that. You want to give the people some stock ideas? Anything compelling? I see a question from Vihan. Any value investing ideas in small caps, mid caps, and large caps? What are you looking at if in event of pullback? Ron, do you have anything?
You do it. You're more in the day-to-day,
Sure.
week-to-week stock picking game.
Happy to. Yeah, and again, my service Value Hunters, we've got a bunch of recommendations that we think are very attractive buys right now. One idea I'm particularly enamored of that I will share and no one will buy. And that's the thing with value investing is for whatever reason, people are just not interested in these opportunities. So even though I think they're great, I have no reservations about sharing because people very rarely take action on it. The company is Marlowe, ticker MRL. It's traded on the London Stock Exchange. And Marlowe is a company that provides fire and safety services. So testing, inspection, and certification for a building's fire systems, its safety systems, its water systems, things like that. The beauty of this business is it's required by regulation. This is a non-discretionary expense. So even in tough economic times, if you want to continue operating your business, you need to have someone come out and physically inspect your property. Make sure, okay, the sprinkler systems are working. You have the fire exits clearly marked. The extinguishers are refilled. So it's predictable, recurring revenue that is regulatorily required. A business like that should trade at a high multiple because it's predictable and it's recurring. They generate lots of cash flow. It's every characteristic you would want. This business does not trade at a high multiple. The company tried to sell itself last year. They didn't get the price that they were looking for. So they spun off one chunk of the business, sold another chunk of the business to private equity. They're just streamlining operations. They are basically just printing cash, and the management team is using that cash to repurchase shares at what I consider to be very attractive prices. So again, the ticker is Marlowe, or the company is Marlowe, ticker MRL on the London Stock Exchange.
Love it. Another ticker related question just came in from Matt. Ron, isn't Garmin a stock you like? Thank you for remembering, Matt. Up 11% today after reporting earnings this morning. That is true. I haven't had even a chance to look at it. I saw it up 14% earlier today. Reported earnings, I think revenues were up 25%, operating income up more than 50%. I'm sure there's some things you got to back out there to do apples to apples, but I haven't had a chance yet. But it is a company I've owned not forever, but certainly several years. Probably during COVID is if I'm guessing right, is when I bought it. Again, using just relative metrics, just to briefly chat about it. 27 times for Garmin. It's not terrible. It's not dirt cheap, especially after today's run up. I'll have to digest what this growth is all about, what management is saying about future growth. Is there any kind of new lines of business or something that is causing them to have earnings that were significantly better than the consensus estimates? So I need to do a little bit digging, but on a day where a stock is up 12 to 14%, It's all good with me.
Garmin's a great example of a company that would have been a good pick for a value investor. Because I mean, the popular narrative, and one that I fell prey to, is this company's going to be a dinosaur. This thing's, I mean, this business is doomed, right? You've got smartphones coming up. Why would I ever need a Garmin? But I guess they have a differentiated use case that's proven sustainable. So anyone who is willing to do the work and hold a contrarian opinion has been nicely rewarded.
Agree. I saw a question. It seems to have disappeared, but it was along the lines of why is EDIT up today? EDIT is Editas Medicine. It's a gene therapy stock that I happen to own as part of a basket of gene therapy stocks that I've owned for years and years and years. Gene therapy stocks in general have been really strong lately, partly because of some good clinical data that has come out, but also because they have been absolutely decimated. So it's a bit of a dead cat bounce there. Funny industry for a value investor to be talking about during a value investing segment. I guess my lesson, just if we're talking lessons there, is if you're going to invest in something that you don't fully understand and that you can't really value, be careful and do it as I've done it in a basket form where you spread your risk out across. I think I maybe at one point owned 11 gene therapy stocks. 4 of them, 2 of them were acquired, 2 of them I sold. So maybe I'm left with 7 or 8 right now. I will have you know that one of them is up significantly and every other one is down. So you almost need that basket to even out your risk. And biotech, as our friend Carl Teal would tell you, has had a rough go of late. Gene therapy stocks were hotter than hot. Gosh, how many years ago? 7 years ago. But really has cooled off. But the technology, the gene editing technology, is really, really interesting. So they're having a good week, and Editas is more of a penny stock at this point, so it doesn't take much to get that stock to jump. But you have CRISPR, Intellia Therapeutics, Beam, or some other ones as well that appear to be on better footing and more established.
Got another one here from Vihan. Ron, if you want to brag a little bit, he says, "Gentlemen, would be nice to hear from your portfolio a value investment idea that produced outsized returns." Outsized
returns.
Thankfully,
you go ahead.
I can start if you want time to think of one.
Sure.
We just tell a story of how this works out in practice. This is a pick that I made when we worked on Deep Value. It's probably 2010 timeframe. It's Crocs, and This was a turnaround. This one had every hallmark of a value investment. It was just a company no one wanted to touch. So Crocs came out probably 2004, 2005 timeframe. It was the hottest thing, and it was plastic shoes with holes in it, and it was just kind of like a novelty. It wasn't really a sophisticated management team. It was basically 3 fishing buddies who came up with the idea. They just wanted a shoe they could wear when they went fishing, and that could hold up to the water. And so 3 relatively unsophisticated operators stumbled upon a firecracker, an idea that caught on. And they did what you might expect. They just tried to expand as quickly as possible. It wasn't very strategic. If you remember, they were just selling Crocs in these kiosks at the mall. That was like the primary distribution mechanism. So
right.
Their inventory was out of control. The channels were terrible. They didn't run the company well, and the stock went up the escalator and then got beaten down. And for years, no one wanted to touch it. Everyone dismissed it as a fad. But they brought in professional management, and I really liked the new guys that came in. They recognized this is going to take a lot of pain. We are going to have to clean up and fix these operations. It's going to take years, and it's going to be uncomfortable, and nobody wanted to endure that. But the price just got so absurdly cheap. And this was a situation, something that I really like is when you see something working, and it's obviously working, and quarter after quarter, management is doing exactly what they told you they were going to do. And you can just see it in the numbers. They are improving and improving and improving. And you can just see a path to significantly higher earnings power in the future. But everyone's clinging to the old perception of the company, and they haven't adjusted to the new perception. And that's what happened with Crocs. This thing was dead money for the longest time, but you could just see underlying the business was getting better and better every single day. These guys were making the right strategic decisions. And this is another one I sold way too soon. I did okay in Crocs, but I should have done great. I sold it way too soon. But investors who bought near the lows and held on, I mean, it's probably at least a 10 bagger, maybe 15 or 20 bagger from the bottom.
Yeah, for sure. Skechers was another one that we did a nice job on back in the day. One that comes to mind for me, which is both exciting, but also there's a bit of a cautionary tale, was Domino's, DPZ. And I want to say about 14 or 15 years ago, I recommended the stock at $4 a share, and it's now at 400. Now, I wish I could say I still own it and have made 100 times my money, but the value investor in me, I probably sold when I made 3 or 4 times my money, maybe like in the teens. It makes me sad just thinking about it. That's life-changing kind of returns, which I did not partake in. Hopefully some of our fools continued to hold it for many years after I did. But it was a great kind of, it was by no means a give me, but they were changing their menu. They admitted their pizza was mediocre at best. It was back in those days. They've done a great job, obviously, with delivery, with digital. And they stumbled a little bit. COVID was good, then post-COVID was not good. Stocks fine lately. I think it's probably around 27 or 28 times earnings at this level here. The growth numbers look pretty good again. So I've actually repurchased it maybe a couple years ago, I want to say. I don't recall exactly when. So I am an owner of Domino's, but from 4 to 400 would have been really pretty sweet.
Yeah. Hey, but like, without sounding patronized, I'm really proud of you. Like, it's so difficult to go through that experience and then buy back in at a higher price and not just kick yourself, say, well, I missed it, there's nothing I can do about it. Wow, that is very impressive to me that you were able to do that. It's something I struggle with.
Yeah, well, I appreciate that. I do think a lot of behavioral finance and value investing go hand in hand from time to time. A lot of the lessons that I said, what you own a stock at is irrelevant, whether you're up or down on a stock is irrelevant. Obviously, letting your emotions not allow you to get either in a stock or out of a stock can wreak havoc on one's portfolio over time. So definitely for those looking to kind of up their game and be even a little more sophisticated, learning when your mind can play tricks on you and stop you from making good decisions is a really important part of investing.
Something that's interesting about value investors is I think we tend to be a lot more comfortable buying a stock as it drops. You say, oh, I'm getting a better bargain. It feels psychologically, it feels good. Like I'm averaging down, right? You know, I'm taking advantage of this bargain price. And we're not as good as averaging up. And that's something, Ron, I know we've seen just watching David Gardner over the years. If a company is executing and the stock price is higher, it could actually be a better investment at that higher price. I know that's something it's really difficult for me to get comfortable with. I'm much more likely to buy on the way down than I am on the way up. But David has shown time and time again, if you've got a company that you think is going to be a winner and they're executing, you can average up, and that's where you can really crush it.
Couldn't agree more. And I also would agree that it's been something that I have not benefited from. I'm not good at it. You know, our folks over at Rule Breakers and David Gardner in particular, as you said, just wonderful at doing that. And sometimes it makes perfect sense when a company is executing and has years and years and years of outsized growth ahead of it. You can pay a little bit more because, as I said, your original cost basis is kind of irrelevant. It's what's the opportunity right now.
Yeah, the longer you hold the company, the more the performance of your investment will reflect the performance of the underlying business. Whereas the shorter you hold the company, the more dependent you are on getting that attractive initial purchase price.
Agreed. Any of these tickers you follow, Rich? Unity, anything there? Any of the oil and gas?
No,
Chevron?
I wish. I'm pretty worthless on any company that you might consider popular. My opinion is going to be pretty worthless.
You know what I do? I sometimes, if I want to play a theme, like what would be a good example? Infrastructure stocks. When Biden put the CHIPS Act into place, and their government was going to be putting billions of dollars into infrastructure. But I didn't necessarily have any expertise in any one particular company. I will use ETFs to play a theme there, which I think is a really great way to buy a basket of stocks. You can do it individually, but if you just want someone to do it for you, buy a basket of stocks that addresses a specific theme. I think is a perfectly good way to go.
And so that's something you did specifically for infrastructure?
Yeah, I've done it before too. I don't know much about banks.
Yeah.
But when I have wanted to participate in financial stocks, I've done it through ETFs. I'm sure there's other examples that are just not coming to me right now. Let's see.
Yeah, keep the questions coming, fools, because Ron and I are running out of steam. We're happy to answer whatever you got.
I'm trying to, there's a question about one of the gene therapies companies, Intellia Therapeutics. It's Intellia, NTLA is the ticker symbol, Vihan. Hopefully that'll help you find it.
Hey, Ron, while we wait for member questions to come in, I'll give you some of my own. What do you think are some of the biggest mistakes that new value investors tend to make?
There's so many, Rich. I would think being too reliant on a spreadsheet, on numbers on a page. As we said, selling too soon. Being too conservative at times. Now it depends. If being too conservative helps you sleep at night, by all means, be too conservative. There's nothing better than sleeping well at night. But I do think you can leave money on the table by being too conservative. Open your mind to potential growth areas. You called it optionality earlier. Build models that have optionality built into them, so you could see what would a stock be worth if Chipotle introduced digital, or whatever. And if you don't even have a vision, just introduce additional growth into your model for whatever. You don't even know for what, but you want a sense of, if this company grows more than I think it will, what could it potentially be worth? It's just a good idea to have that. I don't think you need a multi-page Excel spreadsheets, discounted cash flows. I think just like Mr. Buffett can do it on the back of an envelope, I think many of us can run the same kind of analysis pretty simply. Nowadays, there's so many ways. Discounted cash flow calculators, even all the AI tooling can help us come up with models. You and I used to do something called earnings power value back in the day, which is a very simplified kind of discounted cash flow that assumes no growth going forward. So you could see what a company would be worth in a no growth environment. I think I would don't be too anchored to the spreadsheet. How about you?
Yeah, you brought up a good point I'd like to kind of segue into too, is when I model, it's not just like one precise value point that I'm forecasting. I tend to forecast 3 different scenarios where one, what do I think is most likely to happen? What if things go much better than I think might happen? And what if things just go south? What's a bear case scenario? And so I've got 3 different possible growth scenarios in the future with 3 different intrinsic value estimates associated with them. And then over time, you can track how is the company doing relative to those forecasts. And if it's following, the optimistic path, maybe you could assign a greater probability to that outcome in a blended type of valuation.
Nice. Yep. Totally agree. Ron, are you in a position to share ETFs you are invested into? if they're in a taxable or retirement account. Thanks for the question, Behind. Yeah, I can discuss some that I own. I do have sizable positions in ETFs. I'm probably 50% individual stocks and 50% ETFs. Some of those are broad indexed ETFs, such as the S&P 500, the SPY, the Russell 2000, IWM, the Russell 2000 Value, IWN, RSP, the S&P 500 Equal Weight. So lots of stocks like that. If we're going to look at kind of, and I'm flipping through a spreadsheet here, some sector-based ETFs, I do own, as I mentioned, some infrastructure. An example of that would be the GII, which is the S&P Global Infrastructure ETF. I do own the Fidelity MSCI Financial ETF. I own the SOX, which is the iShares Semiconductor, because I did want to participate in the semiconductor boom that we've been experiencing, but I am by no means a technology analyst, and so I would have found it difficult to make the right call there. So that's the kind of thing I like to do through an ETF. Any ETFs in your portfolio, Rich, or you're purely stock?
No, all stocks all the time.
Nice.
But speaking of stocks in my portfolio, so Therapist Fool asked a question that has 19 upvotes. So this is very clearly what the people want. Ron and Rich, what stocks have you added to recently that you were allowed to talk about that you saw as good value? So I don't buy too often. I buy pretty infrequently, but I believe the stock I purchased most recently was Marlowe. That's the company I referenced earlier, the UK fire safety and security company. But I'll give you another name. I own a company that is in the process of being acquired, and if it is acquired, that position will turn into cash, and so I will then have cash to redeploy into a new investment. And a company that I would happily buy at current prices that I talk about at every opportunity is Burford Capital, ticker BUR. And Burford is the leading provider of finance to the legal industry, which it's not exactly a common concept, but basically what that means is they will fund a lawsuit that they believe is meritorious. So Ron, if you owned a company and say hypothetically you felt Oracle infringed one of your patents, and you consider suing them, and Oracle says, well, we'll countersue you and we'll take you to court. It's going to cost you millions, tens of millions of dollars, years. It's going to be a huge distraction for you. Even if you thought you had a good case, you might choose not to sue that company just because it's going to be such a hassle. It's a legal process. Even if your case is meritorious, you might lose. And if you do, you as CEO, you're going to be in trouble. So you might say, I'm not going to pursue that case. But here's where Burford comes in. Burford says, hey, Ron, I will fund your lawsuit. I will give you the capital to pursue it in court. And if you lose, no problem. You don't owe us anything. But if you win, we're going to get a very attractive return for the capital that we use to finance your lawsuit. These guys are the biggest and the best. They have unbelievable competitive advantages in terms of expertise, data, relationships, brand, and these advantages are self-reinforcing. It's just this very powerful flywheel. They earn phenomenal returns. They've achieved a successful outcome in something like 90% of the completed cases that they've financed so far. And there's a potentially enormous catalyst coming where they finance the case against the Republic of Argentina that's been about 10 years in the making. Argentina has been defeated at every single step of the process, and they keep appealing, extending, delaying, denying. At some point, that bill is coming due. And if and when Argentina pays, they owe Burford an amount that is equivalent to about double its market cap. So Burford Capital, BUR.
I'm a shareholder and my fingers are crossed. For me, what have I purchased recently? Believe it or not, NVIDIA, because I had FOMO, which is not a value investing strategy, but I wanted to participate because I find it incredibly fascinating what's going on. So it wasn't really about making money there. It was about participating in what's going to be an amazing future and technology. Target is I purchased some more Target recently. I mentioned that earlier, as somewhat of a turnaround play, or buying a stock when things are not necessarily going perfectly, and as a result, hopefully getting it cheap and not as a value trap. Yeah, those are the Burford as well. Thanks to Rich.
Yeah.
Yeah, those are some names that come to mind.
Very good. Hey, Ron, do you add money regularly, or do you wait and invest in more of a lump sum fashion?
Well, always through 401k. I'm constantly so putting money into the market there. I consider that to be just as good as adding money to my non-retirement accounts as well. When I do add money to my retirement accounts, to my non-retirement accounts, it doesn't necessarily get invested immediately. It depends on the time I have. Sometimes if I don't have time, that's where I will buy ETFs if I just want exposure, if I want to get capital invested. Otherwise, I'm just patient. Sometimes the cash will add up for a bit. Then, once it gets to be, few percent, 5%, that gets me a little itchy, and I'll start to put that to work. How about you?
Yeah, I try to be fully invested at all times, which is why like I was saying before, I haven't really made a big purchase recently. But then when you have a liquidation event, a monetization event, all of a sudden it's like I'm a kid in the candy store. I have a large amount of capital coming in, and I'm excited to deploy.
Yeah, that's always fun. It's funny how sometimes value investors get disappointed when a liquidity event like an acquisition can occur, because you feel the acquiring company got a good deal, and otherwise they probably wouldn't be doing the acquisition if they weren't getting a good deal. And we feel the stock still has upside, maybe for years to come, that's being taken away from us. I don't get that bent out of shape, because I can just reallocate that capital to something that I like as well. But I see all the time people saying, shoot, I'm going to make a quick 30-40%, but I thought I would be in this for years and have a multi-bagger.
That's precisely how I feel about the company that I own that is being acquired. However, I will say I'm not an insider. I don't know what's happening. You never know what's going on inside a business. Even if you work at the company, you don't always have a complete perspective on competitive dynamics, what the future may hold. So if the management team feels that this was an appropriate price, as an outsider, I disagree. I think they're selling a little cheap, but they have access to much better information than I do, so I should probably be deferential.
That's fair. Yeah, that's fair. Sounds good. So it's 4:00. That went quick. A lot of fun, Rich. Thank you, fools, for joining us. I hope you had fun chatting about value investing for an hour. Really appreciate the questions. Have a great evening. Thanks, Rich. Fool on.
Thank you, fools.
Hello. Well, welcome, fools, to another.
Hello, everyone, and welcome to another hour, or maybe perhaps a little bit longer than an hour, but certainly an hour with Brian and I here on Fool24, both for members at Fool.com as well as on YouTube Live. I'm Tyler Crow. Brian Orelli is with me. Glad we're gonna do a slightly, maybe not the most connected show with the concept of health and high yield, but admittedly, it's a little bit more just for the alliteration of the title than the actual subject at hand today. We can handle a pretty wide gamut of questions that people might have as they're coming in. And we should always remember at the top, we want to give the disclosure. This is not personalized financial advice. Brian and I are here to give our thoughts, our perspectives, our expertise, but we always want to make sure this is for educational purposes only, and please don't misconstrue that at all as personalized financial advice. For those of you who are joining us on YouTube Live, you can go to our question website, Slido, sli.do, and enter the code Fool24, and that will give you access to questions. Just do keep in mind we do have moderators to help keep it neat and tidy, and make sure everybody's nice and polite. Brian, how are you doing today?
Good. I'm all for a nice alliteration. I like your choice. I think mine was drugs and derricks, but I like, if you want to talk about high yield, I can certainly cover health.
Yeah, I mean, high yield. I thought it could cover a little bit more than just oil and gas. With the drugs
Right.
and oil derricks. So
Right.
expand on horizons. It's a Sunday, and as we wait for people to come join us, as well as maybe wait for some questions to come in from members, Brian, was there anything in the healthcare sector this week that popped out to you in particular, or was it a pretty
yeah,
doldrum week?
No, I mean, we had a lot of earnings, and you can go back. We've covered a lot of those. On Friday, Bluebird Bio got taken out for like, I don't know, $30 million or something ridiculous considering the company has multiple products on the market. And it's sort of a little sad because the company has, had a good technology and was able to get drugs approved, but their cures, which is both good for the patient and bad for the company, because when you have a cure, you have to charge a lot of money for it because you're not getting recurring revenue. You're getting a one-time payment and that's it. And that makes things really challenging to get reimbursement for. So I think they've had challenges, getting reimbursement. They've also, took some, I mean, it wasn't 100% that because they took some extra time to get approval, and then that allowed their competitor, CRISPR Therapeutics and Vertex, to catch up, and so that certainly didn't help them at all. But and then they spun off their cancer drugs or therapies, which were arguably had the better likelihood of success, and you can tell that because guess where the former CEO went? He went with the new company, not staying with the old company. So I think it's an interesting deal because they sold to private equity, and it's like a $3 or $2 a share, but then there's a contingent value right. So if the PE firm is able to sell a certain amount of drugs cumulatively in over any 12-month period before, I don't know, the end of 2027 or something like that, I don't have the deal in front of me, then investors get another payment on top of that, which is, I think, maybe even more than the initial buyout price. So when you look at the valuation that investors were giving it was about like maybe a third of the total chance of the total payment. They were valuing it at the guaranteed payment plus 1/3 of the potential payment, and so that tells you that I mean, you got to discount a little bit for time value of money, but basically they're saying there's a 1/3 chance that the PE actually hits that goal by looking at the deal. Anything in your sectors that was interesting this week?
Well, to be honest, I kind of realized this week that there had been so many earnings that I had missed a lot of them throughout the month, actually, and I started to try to do a little bit of like running back through all of the things, especially things in my personal portfolio that maybe I had missed the earnings call or missed the fourth quarter report. And since we are on high yield, I'll go to one of the places that I tend to look for high yield investments the most. That's oil and gas pipelines. One of my largest investments is MPLX. This is like, as the ticker is the same as the name, and a high yield master limited partnership, kind of a subsidiary, if you will, of the oil refiner Marathon Petroleum. It's been a nice high yield business. Hasn't had a lot of growth for the most part because it's hard to grow the infrastructure base in oil and gas these days because we had such a voracious build through the 2010s. You know, everybody was talking about shale and, oh my goodness, we need to move all this product as much as possible. And we built so much of it that we actually were probably had a little too much capacity in terms of infrastructure. And so you've seen a lot of these companies really tap the brakes in terms of growth. But what was interesting to me on the most recent MPLX and earnings call and presentation, which was nice because typically they just like slapped it at the end of the Marathon Petroleum call. They actually like did their own unique presentation this year, so that maybe there's a little bit more what would you call it? A little bit more attention being paid to this business than normal. And one of the things that they mentioned, on top of a faster dividend growth, they announced a 12% increase to their payout, which was great. They had been doing 10%, so obviously the business is doing relatively well. They announced that they were going to be doing some new investments in natural gas, especially in the Gulf Coast area, towards what's called fractionation and exporting. When you have a product like natural gas liquids, things like that, that's actually like 17 end products that you kind of have to divide up and create the end products that you want to. Fractionation is going to basically like take the ethane and separate the ethane from the propane and maybe find some of the petrochemical products that you can pull out of there too. So you do this fractionation process, excuse me, and then you can sell it on the open market. So they're looking to make some significant investments in fractionation and exporting, which is something they haven't done before. They normally just had the pipelines to move it. And so it's a little bit interesting in that the company is going to be able to move towards I guess a new growth outlet, because that's something they haven't had in a while. And I think it's pretty well needed because there's not a lot of growth opportunities out in the oil and gas infrastructure world these days. And so I think that'll be a nice kind of cherry on top for a business that has been pretty prestigious in returning capital to shareholders recently.
Yeah. So speaking of high growth companies at least in the healthcare sector, Pfizer, which has a PE, has a yield of 6.5%, there was a rumor midday on Friday that it's thinking about buying obesity treatment, Viking Therapeutics, and so that was sort of interesting because Viking Therapeutics obviously jumped quite a bit on the news, but Pfizer also jumped quite a bit around the same time presumably on the same news. So I think investors are at least somewhat excited about the potential of Pfizer adding a late stage obesity drug. So they've already read out Viking's already read out phase 2 clinical studies. It was the drug was working quite well and seemed to have maybe slightly better tolerability than what's currently on the market. And they have an oral version that's farther back in the clinic. And Pfizer's efforts into obesity haven't been that great. So I think, investors are certainly seeing the opportunity for Pfizer to get into this space and get into it easily by making an acquisition of a company that's, not going to break the bank for them, a couple of $1 billion probably.
Well, so far, I think we may be having a little. We're having a little bit of a technical challenge for taking in questions, but they should be open now for anybody who is looking to ask questions now. So questions are now open for anybody. As we still wait for a couple questions to come in, there were some older questions in the queue that hopefully listeners are going to be able to, or previous listeners have been able to can listen to this when they can. So often when we can't answer questions during the week, I tend to try to kick them over to the weekend as I have a chance to study. I know one of our frequent listeners, I hope that you're here, Vihan, because you asked me quite a few questions during the week and I wanted to have a chance to address some of them. This was actually last week, and so I wanted to get this one. Vihan said 7 days ago, current thoughts on Baker Hughes. Baker Hughes is an oil and gas company. Ticker is BKR. This was a company I followed a lot more, and then just kind of General Electric bought it. I can't remember, during the 2010s, and I kind of lost track of what they were doing. And General Electric obviously subsequently spun it back off again. And the business that was spun off from General Electric was radically different from the company that it had originally been. It was typically just a drilling contractor. Had some technical expertise in a couple things, but it was kind of a pretty meat and potatoes, if you will, drilling contractor. And I wouldn't even call it necessarily like the best one in the industry. It was probably running like third place to who was it? Third place to Schlumberger and Halliburton in terms of margins, in terms of revenue growth, and in terms of like expertise. But post General Electric spinoff, it's a considerably different company. Mostly because General Electric gave it a lot of its turbine business related to LNG, and kind of also in like natural gas compression and things like that. I think it makes it a much more compelling business, because LNG turbines and things like that kind of goes to like the traditional sense of General Electric, where you have an established manufacturing base that you get service contracts with. So like, big gas compression turbines and things like that, that they're selling, you get the maintenance and service contracts associated with those. So it's a little bit closer to a manufacturer than kind of these, oil and gas service companies, where it's like, well, you drill the well and then you're kind of done until it's time to go do some service work. And typically the service work is not like, you don't have like a guaranteed contract that you get to do the service work later. They'll just contract it out to somebody else and try to get the lowest bidder on anything like that. So it makes a much more compelling business in terms of like the cyclicality of oil and gas. I think with that established base of, you know, turbines, things like that, it'll probably smooth out the volatility that we would normally see in a typical oil and gas services company. And LNG export is one of the, like, I would say, the biggest growth component of the oil and gas industry today. Trying to move oil, liquefied natural gas, in places where it's incredibly cheap, like North America and Australia, and also the Middle East, and moving it to places of high demand, high price, Europe, Asia, and mostly. And so it's one of the underserved growth components, and I think that it positions Baker Hughes relatively well. As far its financial situation's improving, although I wouldn't call it like firing on all cylinders, if you want to use a cliche or something like that. But yeah, I don't see anything that I really hate about this business right now. I think I would have to spend a little bit more time to like come to a definitive conclusion on it. But kind of the first re-look at the business, it looked much more promising than it did, when it was like I said, a pretty meat and potatoes drilling contractor.
Besties asked a question that maybe we can both answer. Recently, which stocks would you buy on the dip? I think there was a value versus value trap hour, and so that I think that question might have been a holdover from that one a couple of days ago. I'll go first, since I thought about it for a second before I asked the question to you. Humacyte, the ticker there is HUMA. The company sells treatments for vascular issues. So what they do is they have these tubes where they manufacture basically artificial vascular systems, and so they coat the tubes with cells. The cells express proteins. Then they wash away the cells, so what you're left with is a tube of proteins, which is what a vascular system looks like. And they're off the shelf. And so instead of, when there's a vascular trauma, like a major cut in your arm or leg, instead of having to go pull a artery out of someplace else and then put it into the, to replace so you don't lose the limb that has the trauma, they can just pull it off the shelf and insert it there. They can sometimes do these with plastics, but plastics tend to have a lot more infections. So they got approval a couple months ago. It jumped up like up to like 550. $5.50 per share, and now it's pulled back to $3.54. And they got approval and they've started the launch, but we haven't gotten updates on sales yet. So I think that the pullback seems a little weird. It's almost back down to where it was before the approval was announced. So I don't know. I think it's a small company, only $455 million. I own shares, but not. I'm not gonna. This is not back up the truck sort of levels, because there's a lot of risk involved in launching a new product, and there's probably some valuation built into the fact that they're trying to develop these things for other indications. So they're trying to develop it for the port, the access port for hemodialysis, and then they're trying to build pancreas like internal pancreases for patients. So you put the cells inside the vascular thing, and then the molecules could go across the membrane, but the cells wouldn't. So therefore it keeps them from getting exposed to the immune system, and the immune system rejecting those cells. You would use that for patients who have diabetes, and then eventually, the goal would be to use them for bypass surgeries. Although those, when it's an emergency, not going and getting a vessel someplace else is not. Is sort of a big deal. In a bypass surgery situation, I'm not sure how much upside there is to using our off the shelf one versus going and getting a vessel from another part of your body. So, but I like the company. The ticker is HUMA, and the company name is Humacyte.
So I guess for my choice, I mentioned an industrial real estate company yesterday, Toronto Realty, but I'm going to stay in this particular area because I think there's some decent opportunities in this area. I'm going to go with Rexford Industrial Realty. I know dip, I think, insinuates like a short-term pricing fluctuation, but this is like a 3-year dip now. It's down about 40% over the past 3 years. And one could maybe argue that in 2022 or something like that, it was maybe a little overvalued, and it has declined quite a bit since then. But this is a business. Oh, sorry. I should also mention too, Rexford Industrial, the ticker is REXR. This is a industrial real estate company. It's pretty simple as that. They own warehouses, they own distribution centers, they own light manufacturing, buildings, things like that, rent them out to, whoever needs them. One of the things that makes them very unique in this space is they focus entirely on the Los Angeles and San Diego metropolitan area, which kind of sounds like it would be like, oh man, that's not a lot of, you're really constraining yourself there in only working in a single market like that. But the Los Angeles, Long Beach, Inland Empire, stretching all the way down towards Bryan and San Diego, their industrial real estate square footage is larger than all of Germany's. So it is a large industrial real estate market. And so there are plenty of acquisition opportunities, nothing lacking, at least in that regard. But what also makes it interesting as well is that these areas tend to be a net shrinking supply area of industrial zoned real estate. Often you'll see in dense metropolitan areas, places that were previously zoned for industrial tend to get rezoned for what commercial, residential, mixed use, something to maybe increase the density of the area, try to provide more housing, just provide more community areas that tends to fall to the way. And industrial real estate tends to take it on the chin when it comes to rezoning. Not often do you get more industrial real estate rezoned in a dense urban area. So the benefit of a net shrinking supply area or metropolitan area of real estate is you tend to have very favorable pricing and very favorable occupancy ratings. They have some of the highest occupancy ratings in the country. It's like less than their vacancy rates are frequently less than 5%, and rental growth for like lease growth tends to be in the double-digit range pretty consistently because it's in such high demand. And so that has made it gives Rexford a very advantageous market to operate in. And what I do appreciate about the managers specifically is they have grown the business well on a per share basis and not just simply growing it for the sake of growing it. Management tends to have a pretty good eye for value. They have a lot of like connections in the commercial real estate, realty, with realtors and things like that, and they tend to buy a lot of off-market properties, instead of compete having to do competitive bids with other people, which tends to lead to poor returns on your property. So a lot of the things that they do between the way that management operates, the strategic aspect of the business, the reason that it has dropped as much as it has, I would say, is number one, rising interest rates. Because if you have much higher interest rates, all of a sudden a 1.7% dividend yield for a REIT doesn't look that compelling, even though Rexford does have pretty considerable growth. It has had, very robust growth in terms of dividend for a long time, well over the double-digit range. Even by that standards, 1.7 is pretty meager. And so when I can go get 4.5%, 5% from a treasury bond, it's a little bit more competitive. And so today, because of that precipitous drop and some dividend increases, it's a much more like reasonable yield, I think, for this type of asset and the growth profile that it has. Its current dividend yield is 4.1%, and I know there's obviously higher interest rates is going to slow down growth, and refinancing will sap cash a little bit, and concerns about trade could be a big thing, because I think 40% of all container ship imports in the United States go through the Long Beach and LA port complex. So, especially trade with China and Southeast Asia, if we see a decline in that, it could have an impact in this area, much more so than other real estate areas, which is a possibility. But I don't know if it'll be I don't know if tariffs or anything like that is going to constrain total trade flows enough that it would like collapse the industrial real estate market in the Los Angeles area. So for something on the dip, that's kind of one that I've been looking at.
So what do you think the reason for the pullback has been?
Like I said, I think higher interest rates, basically, like, competitive cost of capital. There has been there was like that 2020, 2021, like voracious demand for industrial real estate too, because we're like, oh my God, we're going to do everything e-commerce now because we all are going to live indoors for the rest of our lives, right? Well, that wasn't necessarily true. I think there might have been a little bit of an overbuild nationwide, and so that kind of there's going to be some immediate spillover effects almost regardless of any market. I mean, even as robust as LA's, it's been pretty good. And and we've seen some slowdown in rental growth. They were talking about lease spreads during 2022, 2023 of like 60%, which is insane. It's not sustainable. Today they're looking at lease spreads in the teens, which is still really good for real estate in general, but it's not the voracious pace that it was at before. And so I think people are just looking at it and thinking it's just not quite as growthy as it used to be. But despite that, 4% yield that's growing at 10% annually, I still think that's a very reasonable price to pay.
307 Fool asks about the potential, there was news about a potential new virus out of China. Any thoughts on how it might impact companies like Moderna, ticker mRNA, and you could probably throw in all the other vaccine companies, and probably some companies that are involved in developing treatments for viral infections as well. So this is really, really early stage, like not even clinical at this point. Nobody's developing drugs for this thing because there's no evidence that it's doing any harm to humans. So as best I can tell from this journal, from this report in the journal Cell, what they did was these researchers basically just looked at viruses in bats and then tried to figure out whether they can infect human cells, and they found one that isn't SARS-CoV-2. It's HKU5-CoV-2. So it's related. It's in the same family of but it's not the exact same virus. So it enters through the same ACE2 receptor on the human cell, but we don't have any evidence that it's doing any harm to humans. And I think they compared it to SARS-CoV-2, and it seemed to not be able to infect human cells as well. So I don't think there's any potential upside at this point. I think the fact that mRNA drugs can be developed so quickly because all you needed to know is the sequence of the protein, on the surface of the virus, and once you know that, you can create an mRNA that expresses that surface protein and therefore get an immune, and in theory get an immune reaction. So it doesn't seem like it's, that's the advantage of mRNA, not necessarily that it can react to something in the future that we might have, but I don't think this is necessarily going to be it in any realistic fashion until it is. It could be in the future, but I don't think there's any reason to add any value to any of the vaccine companies because of this report. I don't think there's any evidence that it's causing any problems in humans.
We can both hit this one. I need input asked. It's kind of a nice generic one that we can kind of go in any direction. But what are your current convictions, small, mid, and large cap stocks at current levels for very long term? The nice thing is we kind of go in any direction we want here. I'm going to punt on the large cap side of things because I admit I don't look at as many large cap companies. I tend to focus a little bit more on small and mid cap, just by the nature of the companies that I or the industries that I look at and things like that. There's just not as many, with maybe like the exception of the oil and gas giants. And even them, what is a large cap these days? Is it more than 100 billion? It seems like it's always as long as I had been working in this industry, like small cap meant like less than 2 billion. But when we have $3 trillion companies these days, it seems like 2 billion is a little too small for small cap, right?
Yeah. I don't know. In biotech, I say anything, maybe north of 10 is mid cap, and I don't know. There's sort of like there's a sort of a weird range. So there's like less than 1 billion, which I would call, most people will call micro caps, but in biotech, that's a vast majority of preclinical of clinical stage companies is probably in the maybe less than 2 billion market cap, and then there's sort of mid-range companies that have drugs on the market that are in the 5 to 15, 20 $1 billion market cap, and then there's large pharma that there's usually a big jump between having the valuation of having one or two or three or four drugs on the market and having 20, 30 drugs on the market, and so I don't know. So I think it almost has to be industry specific. Yeah. Even though everybody likes to have nice neat numbers, I think it may vary depending on the industry.
Sure. Well, I'm going to do my best to try to answer it. And I think what I have is I probably have I have like a mid cap, or maybe it's somewhere between a mid cap and a large cap because it is an oil and gas company, and the other is a small cap. And so for the large mid cap, I would say Total Energies. This is one of the integrated oil and gas companies, very similar to the Exxon Mobils or the Chevrons of the world. It just happens to be the one that's based in France versus the ones based in the United States. One of the things that I have owned this company for a very long time, and one of the things I've greatly appreciated about this company, there's quite a few things actually. It's been relative to like the European oil and gas companies, like that we would think of like Shell and BP, I think those two are just kind of hot messes in terms of like corporate strategy, investing, underwriting, things like that. They've always tend to underperform, but Total Energies has done a considerably better job in terms of underwriting, in terms of uh, you know, project execution, things like that. So their returns have been considerably better. Their, returns on capital employed, invested capital, however you want to measure it, tends to be on par with the ExxonMobils and the Chevrons of the world. You know, despite its valuation being considerably lower than ExxonMobil and Chevron at any given moment. The other thing I do appreciate about the business is that uh, it is one of the rare companies in the oil and gas industry that has actually figured out how to invest in renewables or in something outside of fossil fuels and make a decent return. A lot of these integrated oil and gas companies have tried. We've talked about like algal biofuels and BP getting into wind, things like that. And most of these efforts have more or less fallen flat on their face. I know ExxonMobil's now working about drilling for lithium in like Arkansas, and I don't even know what Chevron's doing in this regard. But Total Energies has been quite good at developing renewables at good returns. They went a lot into basically like electric utilities in Europe, especially ones that are based in natural gas, and as well as investing in solar. And they do have a very robust pipeline of solar generation that they're building across Europe and across basically the world. And with an average return on invested capital for its renewable business in the 10% range, that is like multiples larger than what we see at most of the other integrated oil and gas companies. So it gives them a little extra lever of growth, a little bit more diversity outside of the traditional oil and gas business. And this is a business that trades for like it has like a 6%, close to 6% dividend yield, trade like 9 times earnings. It is considerably cheaper than any of the American oil and gas companies, despite I would say on par in terms of execution and returns. And then on the small cap side, for me to keep going here, and this is going to be in a completely different direction for those who probably listen in and have heard me on shows a bit. This one's going to sound, I think I've mentioned this one quite a bit. It's BBB Foods. The ticker is TBBB. It is a hard discount grocery store in Mexico. It just got its start. They IPO'd last year, and it's a business that I've followed since the IPO. I really do have a lot of respect for what management has been doing there. The IPO perspective was like this love letter to grocery stores that the CEO wrote, and I appreciate it a lot. And I think it has a lot of qualities that I like to see. There was an immense amount of detail in its prospectuses telling them like exactly like why we succeed in groceries versus relative to a lot of its competitors. And it's proven out. They have like incredible inventory turnovers. Same store sales have been in double digits for many years. And their store counts like 26, 27. I think they're going to report, I think maybe this week actually. So it will 2,600, 2,700, excuse me. They're supposed to report this week. So we'll get the store count increase, but they're expected within like their long-term target is 20,000 stores across all of Mexico. So between like same store sales growth and its store count growth, I think there's a lot of opportunity there.
Yeah, so for my small cap, I'll stick with Humasite, which I just talked about earlier. For mid cap, I most recently bought Moderna. So I was pretty much a bear on this company all the way up and most of the way down on the valuation. I like the technology, and I think that it's got a lot of potential, and obviously they generated a lot of cash. But I always thought it was overvalued, and now it's dropped into the $13 billion range, and they're expecting to have sales of, I don't know, 2 billion for 2025. I think the range is pretty big. It's like 1.5 to 2.5. So I took the middle of those two, but at 1.5, maybe it's a little, it's not a super great deal. At 2.5, it's a steal for 13.7 billion, considering how much cash on hand they have and their potential for their pipeline. And then, in the 2.2 range, I think it's a good deal, but not a steal. And it jumped up quite a bit over the last couple of days since I bought it last week. No, the week before. So, I think I like the company now, and I took I didn't take a large position, but I did take a position in it because I think the value seems reasonable. And then for large cap pharma, although I don't really invest in them, I think Pfizer's has the best potential. That you've got a dividend that you can sit on that's 6.5%. That allows you to have some downside protection where you don't necessarily want, you're not really worried about it falling much more than that, because if it falls much more than that, then people will buy it just for the dividend. They don't even care whether they get any return off the stock itself. So that provides some a little bit of safety. And then it's gonna be a slow grower for a couple of years, but you're gonna get paid to sit and wait on that growth. And if they get a couple of exciting uh, approvals or phase 3 successes, or as we talked about earlier, maybe an acquisition that can drive sales fairly quickly, then that should help grow the company over the sort of midterm to long term. So I think Pfizer's a good value at the current price of the large cap pharmas. I feel like it's the safest of the valuations. And so, I feel like it's cheap. It's not necessarily going to grow as quickly as, it's not going to grow as quickly as an Eli Lilly for certain over the next 5 years. But Eli Lilly is so much higher valuation. We're talking about, Pfizer's at a market cap of 150 billion and Eli Lilly's at a market cap of 785 billion. So, Pfizer doesn't have to grow as fast as Eli Lilly to justify its valuation. And so I think there's a lot of, while Eli Lilly is doing well now, if there's a pullback in their growth rate, then that's going to hit the stock a lot more than Pfizer if they go from, whatever they're doing right now to, losing a few percentage points. It's not as big of a deal as Eli Lilly potentially losing, 10 percentage points on their growth rate.
Yeah. So actually, I want to follow up on this because I believe like one of the last times we talked, one of the things you mentioned was like when there's a really high dividend yield on like one of these pharma giants, it normally means like they're about to have like an off-patent moment or something like that people are a little bit nervous about. What is Pfizer's like off-patent moment
Yeah,
coming
it's like
up that
it's like
people have a
2
little
or
bit
3 or
scared?
4 drugs that are all going off patent in like 2030. So they're actually growing at a decent rate right now. But if you look at their, because these things are all known, it's not necessarily like one. It's not like a Lipitor where it's like, Lipitor was like $10 billion in sales, and that was a big percentage, maybe 10 maybe more percentage of their total sales. This one's like 3 or 4 that each equal 10%. And so, it's not necessarily one drug, but we know that they're all going to go off patent around the same time. And so that's the concern that, and that people know about. And so, it's filling that gap plus being able to grow, right? I mean, they should easily be able to fill that gap, but that's going to result in minimal growth. And so a good pharma company, I think, grows it at like if they hit 10%, I think you should be happy because you getting 10% growth in revenue. Hopefully they can increase the bottom line by more than 10% because of efficiencies, and then then you're getting a couple percentage points of revenue of dividend, and that's sort of like a healthy, happy pharmaceutical company. So this one's definitely not healthy and happy. No way it's going to hit 10% growth over the next 5 years unless it makes some major acquisitions.
Um, I know you probably have, it looks like there's quite a few medical questions in here, so I'm going to let you see if you can find one for a second, and I'll just do a quick response that I need input because he asked about Kelly Partners Group, which is something that he's asked me about before. I do apologize. I think that previous questions for this one had been removed from the queue. So when I was doing my weekend prep, that one wasn't there, but I will be on over the next couple of days. So if you do stick around, I and we'll keep this one in the queue, and I will remember to do it for prep for the next couple of ones. So, Brian, is there anything you're seeing that you wanna hit really quick?
Yeah, William Jacob asks about Merck. Ticker there is MCK. Wait, M. Yeah. Let me just double check because somehow that didn't seem right. Pretty sure it's
MRK. MCK is
MRK.
McCormick, the spice
Yeah,
company.
right. Yeah, I knew that. Yeah, so MRK. So and then just realize that there's a German Merck and a U.S. Merck. So the German Merck doesn't trade on the U.S. stock exchange. So you don't have to worry too much. But just when you hear about different companies getting, having drugs, you just make sure you've got the German Merck versus the which goes by GM. It has GmbH, I think, at the end of it, versus Merck and Co., which is the U.S. company. So the William notes that the PE is 13 and the forward PE is 9.9 with a good cash sheet and a cash flow. It went down a lot. Thoughts? This is another one where we've got an upcoming patent expiration. So this one on Keytruda, which is their main cancer drug that the immunotherapy, and Merck spun off a whole bunch of their other drugs into a separate company, which made Keytruda even a larger percentage of the total. Yes, those drugs were growing slowly, and so they weren't all that interested in them, but that just made this patent expiration be even more severe. And so I think that's, even though it looks like a good valuation right now, I think again the investors are valuing it as if that they know that patent is coming, and so that's the reason why it's the valuation it is. The dividend yield's only 3.6%, so I don't think that this one has as much room to, this has more room to go down potentially before dividend yield investors start stepping up and trying to buy it just because of the dividend yield.
So Vihan asked for me, and this is home builders, not exactly the most high yield sector, but like I said, we'll go anywhere if the questions are right. Looking at home builders and intriguing valuations, kind of was looking for the top 3 out of 4 with NVR. Ticker is the same. Greenbrick Partners, where the ticker is GRBK. Lennar is LEN, and I think they also have a B share, LENB. And then DFH, Dream Finders Homes, is the last one there. So, and then there's another question at the end about REITs and taxables, and I can hit that when I'm done. But of those 3, I would probably, I own Green Brick Partners, so I would probably put that as the best one. I've said this before. I think they're the best underwriters in this industry. Great returns on capital, low. Returns on assets. That's kind of a little bit more important when we're looking at these kind of businesses. It keeps a very low debt profile, despite the fact that, everybody in the industry has been trying to go to capital light, asset light, land light. They underwrite all their other things. They develop their own land, and they somehow still keep a lower debt profile than anybody else. I think their underwriting is stellar. They do a very good job of managing growth, as well as look, if the stock's really cheap and we don't see a lot of compelling opportunities, we'll buy back stock. And so it's a business I appreciate a lot, and I think they're incredibly well managed. NVR, I'll go with them right afterwards. They are by far the best. They have been the best in the industry for decades and decades. Greenbrick is much newer. They're the best operator, I would say. You look at up and down their balance sheet and their income statement, it's hard to deny what they do. I think they're one of the few companies I've looking through all the home builder reports that have reported so far. They seem to be the only one where backlog was actually increasing recently. There's still quite a few of them to report so far, especially some of the smaller ones. So we'll see how that plays out there, and just returns, very efficient with what they do. And then I would go Lennar after. There's a lot of very good companies in this business, and good capital allocators, all trading for very reasonable valuations. Lennar is kind of unique because they just spun off all of their land development into a land development REIT called Millrose Properties. So there, I'd have to go back and now that this spin-off has happened, I'd like to go see like what the balance sheet looks like in the first quarter. So before I make any like definitive statements about it, but so far it's been a quality operator. And the reason I left Dreamfinders Homes off is I haven't been impressed with their operations. I know there's a lot of I should mention this. I am a contributor to the Motley Fool. I am not one of the analysts making active recommendations. I know that Dreamfinders Homes has been an active recommendation in several places, but I tend to be a dissenting voice on this one. I think their operations have been a little bit subpar relative to a lot of the other ones. Their growth has come from more communities versus like efficiently selling at the existing communities. They have a thing called absorption rates. It's a measure in this industry of how many homes in a community you sell per month. And the higher that number is, it tends to be you're a more efficient seller. So your sales as a percentage, your sales, general and administrative costs as a percent of revenue go down if you can sell more within communities. So their absorption rate has always been a little subpar compared to the rest of the industry. As a result, their SG&A costs as a percent of revenue have been higher, and things like that. Just as much as they say that they're the baby NVR because they implemented the same like land strategy, I think on the operational side they leave something to be desired. And then just on that last part, do I own REITs and taxables? I'm trying to think. I don't think I do right now. Not U.S. traded real estate trusts. I own some ones that are traded on the Mexico exchange, but I wouldn't get the taxable advantage on those anyways. And so I can't think of any, but it's not like it's a deliberate choice. I tend to try to invest in REITs in a tax advantage account for the simple reasons, like if I'm going to have reinvested dividends for a long time, don't want to pay taxes on them. But if I find a good opportunity and I don't have available cash in a retirement account, I'm not afraid to make that investment in a taxable brokerage.
Vihan asks about Globus Medical and MedPace. Both of them reported earnings fairly recently. So Globus is a spine musculoskeletal medical device company. The sales in the fourth quarter were up 6.6%, or if you look at it on a constant currency basis, it was 6.9%. If you look at the whole year, it was up 60.6% as reported, or 61.1% on a constant currency basis. So you're thinking like, was the fourth quarter just horrible? And yeah, it wasn't that great. But the reason why it looks the way it does is because in September 2023, they closed their merger with NuVasive. So the 2024 had 3 quarters of, or almost 3 quarters of benefiting from a comparator year where they didn't have NuVasive, and then this most recent quarter was the first full quarter where they were comparing the combined company on a year-over-year basis. So I don't know. I'm not really going to get too excited about 6.9% growth on a constant currency basis. I think I'd like to see them be launching new products that are driving that into the double digits before I would get super excited about the company's long-term prospects. Whether it's a good value right now, I don't really follow it close enough to understand the company on a deep value basis to try to figure out whether it's actually a good value. For MedPace, this is a CRO. So they run clinical trials mostly for small biotech companies. And typically they're focused on early stage phase 1, phase 2 clinical trials. And I think they may also have animal models that they can use for preclinical, if I remember correctly. So in the fourth quarter, revenue increased 7.7%. So that was not too shabby. But then they also report new business awards in the fourth quarter, and those were down 13.8%. So those new businesses will actually show up in future quarters, not necessarily in this fourth quarter, but that sort of shows that growth in the future is not going to be, may not be as good as that 7.7% revenue growth in the fourth quarter. So again, I mean, I'm not sure this is really the best quarter. I think the funding environment for biotechs is really difficult. There's a lot of companies that probably have preclinical assets that they'd like to run phase 1 clinical trials on, but they can't because they don't have they don't want to spend their cash that they have right now on a late asset or on an early asset, one that's going to take a long time to progress, when they have a phase 2 asset that they can potentially move in, they may be moving into phase 3 if it reads out successful phase 2 data, and so they'd rather hold on to their cash and not run that phase 1 clinical trial on the new asset. Or even sometimes companies will be testing their drugs for multiple different diseases, so they might have a disease that they're testing it on first, and they have ideas of how it could also be expanded into other indications, but they don't necessarily want to spend that money on the phase 1 clinical trials, given their low valuations and inability to potentially raise capital. So I think if interest rates go down, then that will help drive the valuations up, and then that would potentially help MedPace Holdings over, let's say the next 2 or 3 years. But currently it looks like, the next year might be a little bit challenging, considering that new bookings went down 13.8%.
So I'm gonna, this is actually a older question, but I know that the person who asked it is with us, so I'll answer it now. Vihan, I think about 7 days, like last week actually, probably right around this time, asked about my thoughts on the Chemours company. Ticker is CC. I think it would be an apt time. It is a company with a dividend yield close to 6% right now, so it's very much fitting in the high yield theme. This is a chemical manufacturing company that builds a very unique blend of chemicals, it has a very unique portfolio of chemicals. It has refrigerants. So, used to be like Freon, Xeon, gas, and things like that. They're trying to build a new one, which is a low greenhouse gas intensity one. I think it's called Opteon. Yeah, Opteon. So kind of on the Freon gas sort of thing. Just a slight chemical composition change, but still a hydrofluorinated gas. They also make titanium dioxide, which is a pretty common input for almost anything. We use it in some foods, we use it in some drugs, we use it in plastics, papers, coatings. It's a white pigment item. So basically, if you're trying to make anything like a white, bright white, tend to use titanium dioxide a lot. And then they have they call it advanced materials. It's basically like Teflon. This was a business that was spun out of DuPont. It was spun out of DuPont several years ago. It was basically a way of like DuPont unloading a bunch of product liability suits, because obviously when it had Teflon and some of these other perfluorinated alkylated substances, so basically PFAS, the forever chemicals that we've been seeing in the news so much, it came with a lot of product liability. I think there was even some product liability around some of its refrigerant gases as well, because of the greenhouse gas capabilities and things like that, although not quite as like prominent in the legal circles as it's like the Teflon stuff. So I think it was it's like a cast aside. It was a way of like Dow trying to, save its portfolio from getting absolutely blasted with product liability cases. But they came to a little bit more of agreement there on the cost sharing for those liabilities. And I wouldn't say all, but a decent portion of those have been paid out and predicted. So like there's not a whole lot of like major downside risk on product liability for Chemours as it used to have. So that's a good thing. 6% dividend, it hasn't grown in years. This is a very, very cyclical business. Titanium dioxide tends to be very like related to the construction industry, mostly because, it's used in white paint. And so between that and the ups and downs of like the automotive market and or the what am I trying to think of? Just basically the other markets that use a lot of refrigerant construction. It's been an okay business, but all in all, it's been a a very slow, slow growth, maybe like GDP a little bit over GDP at best, and very cyclical. It has been in what we would call a down point in the cycle. So people who want to be like opportunistic investors in cycles, this would look like one of the more attractive times based on like the cyclicality of its earnings. But all in all, it's not necessarily a business that excites me a lot. There's not a lot of growth in its portfolio today. I know they're trying to say that some of its refrigerants can be used for like AI development, but I'll buy it when I see it.
Zach asked about Medtronic, ticker there's MDT. They reported earnings on Monday. They're off cycle, off the normal, quarterly cycle. So this is the quarter that ended January 24th, 2025, and they call it their third quarter. So just to keep that clear, so revenue in the third quarter increased 2.5% as reported, and then if you look at organic growth, it was at 4.1%. So still, better than the 2.5 is, abysmal, but 4.1% isn't that great. They do highlight some things that are going well, including cardiac ablation solutions revenue that increased in the low 20% range on strength of their pulsed field ablation products. But the problem that I've always had with Medtronic and pretty much any large medical device company is that they don't break out their individual products. So they only break it in, Medtronic specifically only breaks it down into their cardiovascular portfolio, which grew by 5% organically. And then they have their neurosciences portfolio, which grew by 4.4%. Or 5.2% organically, 4.4 as reported. And then their medical surgical portfolio, which is the one that's growing really slowly at 0.4%. And then diabetes is doing the best at 10.4%. But within each one of those, 4-5 segments, they don't report the individual products. So, telling me that the cardiac ablation solutions is growing by 20% doesn't really tell me a whole lot and tell me how quickly that might grow the cardiovascular portfolio that's growing at a 5% organic clip, because I don't know what percentage of the total it is, and I don't, so I don't know. I find it really hard to value the future potential of companies like this, and so I have never invested in Medtronic for that reason.
Of like the medical device companies, though, would you say that Medtronic is more diversified? Because it seems like there's in the like the same in like the pharma world, you have like these medical device companies that cover a pretty wide gamut, and then there's like the specialists and
Right.
who do like one or two things, which seems as speculative or sometimes more speculative than like the early development stage pharma that only has one.
Yeah, I mean, it's less risky for certain. If they have one product that suddenly gets competition, that they had that in their in their diabetes pumps. So they decided that they would integrate their pumps and their glucose monitor and their insulin pumps into the same machine, but then I think they might have had some manufacturing issues or something, and so then they got that hurt them, but not nearly as bad as if a company like Insulet that sells only insulin pumps got hurt. If they have a manufacturing problem, they're going to get hurt a heck of a lot more than Medtronic did. So yes, that's true. But again, I think like just going back to the general, like trying to value the company, I find it really difficult compared to like a pharmaceutical company where, they might have 20 or 30 drugs, but they're going to list like almost all of them. They might throw like 5 or 6 that are sort of small and make up, maybe less than 10% of their total sales, they might throw that into one category and call it other drugs, right? But a vast majority, 90% plus, you're going to get a readout on an individual product basis. And so you're going to be able to understand, like, we're launching a new product, and you can say, okay, well, that's a new system, so we're going to get new sales, versus we're launching a new product, but it's going to be cannibalizing sales of this product that also treats that same disease. Well, now, that I can value that, right? And maybe, it's higher sales, or maybe they're going to get it's a better drug, so they're going to take some sales. They're going to take some sales away from themselves, but they're also going to take some sales away from competitors. But with Medtronic, they tell you that they're launching new drugs or new medical devices and all, but it's really hard to know how to compare that to what they currently offer. And when they say that they're doing things that are really, they have one product that's doing really well and the launch is going really well. Well, that doesn't really tell me anything over the, because you haven't told me the sales. I don't know how much of that is driving that growth of that individual segment.
No.
So there's my rant.
A nice rant to end on. You get Medtronic off your chest, because we have gone ever so slightly past the top of the hour. So Brian's going to be saying sayonara for now, and looking forward to seeing you next time. And we'll be having Jeff join us for the next couple of hours. Jeff, how are you doing today?
I'm doing well. Good to see you guys.
Yeah, and this is a pretty special weekend, because at least in the investing circles, because we got a Berkshire letter, and I wanted to save any discussion about the Berkshire letter to go with you, Jeff, because we chat a lot actually off channels and off videos, things like that, and it tends to we went to Berkshire 2 years ago. We've been kind of talking about going this year as well, so I thought it'd be a good kind of open to talk about, like, reading the letter. Was there a couple things that maybe stood out to you, and maybe we can, if anybody had questions about Berkshire or the letter or something like that, be a great time to ask it.
Yeah, I read through it this morning in preparation for this. I highlighted a couple of things that stuck out to me. It's funny, I don't know, you might think of it differently than I do. I always get drawn to the less about the specific numbers about Berkshire parts of the letter, and more about, like, the investing wisdom, the life wisdom. I think that's the reason a lot of us are drawn to Warren Buffett and Charlie Munger when he was still with us. And it's this, like, folksy way of writing and telling stories that you would expect from a man in his mid 90s, but it's not cringy. It still feels relevant. It's like your grandfather who you love is talking to you about life lessons. So that was, like, there was a lot of that. It's almost like I feel like each year there's a little bit more of that in the letter, a little bit of that folksy, here's my take on the world kind of stuff. But one of the first things specifically that jumped out to me, and I think we could probably chat about it for a few minutes, Tyler, is, at the end of page 1, he basically talks about how much he, in this letter, admits to mistakes, talks about errors, things that he and has done wrong as the leader of this company, and kind of takes a swipe at just about every other publicly traded company other than Amazon, which he mentions also took some public swipes at themselves in their 2021 letter. But basically saying, like, that's part of the deal. You have to talk about the mistakes you've made because you are someone who people have entrusted their money with. Right? That's always the vibe of his letters. He seems to take very seriously the job of stewarding people's invested dollars forward. And and then he goes on to talk about mistakes and makes the point to say, when it's a mistake, I'm going to talk broadly, and when it's a praise, I'm going to mention the specific person. It goes on to do those things in the next couple pages. So that was the first thing that jumped out to me. We can dive into more specifics, Tyler, but what about you? What was the overall take?
It was funny. It was actually the same thing too. It's the candor and clarity that he provides that is, as kind of a general market commentary, just kind of woefully missing from so many other companies. And I think that there was a little bit of, like you said, a little bit of a swipe at companies, basically, everything they do is putting lipstick on a pig sort of approach to how they do it. Everything's always awesome, everything's wonderful, everything's perfect, and not, being introspective with what went right, what went wrong, how can we be better, and things like that. And so a little bit of that, as well as to me, and perhaps it was just me projecting my thoughts into Warren Buffett's writings, but it almost kind of seemed like a call towards like shareholders as well, of like, these people do work for you. It's not like you're there to worship at their feet as the almighty CEO or something like that, who is, just doing perfect things all the time. They are kind of your employees, and they should be able to be frank and candor with you about what's going well, what isn't, what can we do better, what were some of the mistakes we made, and how can we learn from them. Because it was like it came out, and it was like, first couple paragraphs he mentions these sort of things. I was like, man, he's ready to throw some fastballs this year in the letter. Because when he opened like that, I was like, this is something we don't get anymore, and it's very refreshing.
Refreshing's the right word for it, because as I've become an investor who likes to read the earnings, either letters if there is one, like a shareholder letter if someone writes one, or at least listen to or read transcripts from earnings calls. When I come across a management team or a CEO who's as candid as Buffett is in these letters, and frankly at the Q&A at the meeting as well, I'm immediately drawn to that company and that stock and that management team, because it's so rare. I can count on at least the companies that I've either owned or followed in some capacity. I can count on probably one hand the management teams that jump out in the way that, with that level of transparency. And, I'm typically not a person who is like, oh, in the old days, things were better. Like, that's not my vibe. I'm a little bit more of like a person who questions how things have been and embraces change. But I don't know, when it comes to the way Buffett manages himself and the company, it does feel like we've lost a lot of that in corporate America in terms of when you listen to earnings calls. And, it's interesting. We don't have to talk about it necessarily, but I was going through the old questions, and someone asked a question about ServiceNow, which is a company that I own and follow. And I was just listening to their earnings call, and Bill McDermott, is it McDermott? I think it is. Who's the CEO of that company, is just like so bombastic and in your face, and we're gonna do this and we're gonna do that and we're killing it and we're awesome. And and I'm not saying that pejoratively. That's just his vibe, and I actually kind of like it because it's entertaining and energetic. But it's just so different, right? It's the spin. Here's all the things we're doing well. He'll answer a question honestly in the Q&A part and talk about things that have maybe been not as perfect as they could be. But it's just, I think there's more of that in your face, here's why we're great out there, versus like an introspective, we are people who are shepherding your savings,
Mm-hmm.
So yeah, refreshing is a good way to say it.
Yeah, I was just going to say there was one other thing, and it was just a further down. It was one of the things I found finding funny is he like took a swipe at us, like financial media people who talk about stocks a lot. There was this mention of like, there seems to be a lot of chatter about us having a lot of cash right now, and like, oh, that we have more cash than equities. He's like, hey, you all remember that we have 189 wholly owned companies, and that we those publicly traded companies that we have to report. I mean, he said it way more eloquently than I'm describing, but was like, we have 189 companies. We have investments overseas that we don't have to disclose in 13Fs, like he mentioned, the 5 Japanese conglomerates that they've made substantial investments in. So that, that those striking CNBC headlines, or wherever where any other financial outlet you're seeing, it's like, Berkshire's mountain of cash surpasses his equities. He's like, no, that's really not the case, guys. Like we're still majority invested. And, a kind of a reminder, not just of like, kind of the some of the ways that we generate headlines in financial media, but also like just a reminder of how big Berkshire is under the hood, because so much discussion is always about like the publicly traded portfolio, but there's so many wholly owned entities in there that are probably, I wouldn't say multiples, but pretty close to multiples larger than its publicly traded portfolio.
Yeah, and it's funny. I think about like my process of being aware of Berkshire and learning about it over the time from like when I bought my first stock to like now. And, I started like very basic, like Warren Buffett is a good investor. Like that was like what I first knew about him. And then I'm like, okay, so a big part of the company is insurance. Okay. Oh, he uses the insurance float to buy stocks. So that's where the investor piece comes in. But then when you start reading the 10K, or even going to the meeting and walking through the little exhibit hall that's all of their, own subsidiaries. But if you read the 10K, it breaks it down by, however they categorize them, all the different minority, tiny, small companies you may never have heard of that, or maybe that you had no idea were owned by Berkshire, like the Brooks Running Shoes Company or Fruit of the Loom, like Dairy Queen, right? Like all these companies that until you really dig in, you don't know, like you don't think, when you think Berkshire Hathaway, I don't think most investors think Dairy Queen, right? They think Geico, or they think Apple Investment or Coke, right? And yeah, it really kind of opens your eyes to, there's so much about this company that has led to its success that no one ever talks about. And a lot of people probably don't even know. And yeah, there was a lot of attention paid to that in the letter. One thing that kind of blew my mind, Tyler, that I highlighted when I was reading it today. He had the whole section about how much they pay in taxes. This is wild.
That seemed like a mild swipe at maybe a few other companies and discussions that we're having these days too. But
yes. Here's the quote. To be precise, Berkshire last year made 4 payments to the IRS that totaled $26.8 billion. That's about 5% of what all corporate America paid. And then he goes on to say they also paid state and local taxes too. That is wild.
Yeah.
Berkshire Hathaway alone was responsible for 5% of
over
all
$100
corporate
billion.
taxes
That's
paid.
wild.
Yeah.
So we actually got a question related to Berkshire too, and it was a large discussion in the letter as well. Sadaf asked a few minutes ago, what is your conviction or thoughts, I guess, about Greg Abel? What is Berkshire without Buffett? I think that's an interesting question, because he did start to hint like, hey, Greg's going to probably start writing these things a little sooner than later. And
yeah, he actually said basically that. Yeah.
Yeah. So I don't know if he's hinting at anything immediate, but he's always been very candid about the fact that he's 95 and often pokes fun at it. And Greg Abel has been kind of the heir apparent for some time. So I'll give my thoughts for a second, and then you can give yours as well. But I'm not worried, but I do think it's going to be very different. I think Warren Buffett certainly gets a pass a lot more than a lot of other people would, because he is Warren Buffett. This has been his business for a long time, and many of like his Class A shareholders are like his friends that were probably invested him back in like the 1960s and have just held it forever. And so I think when Warren Buffett did make mistakes, and maybe as at the very few times where like it didn't do well, obviously in like raging bull markets of like the 90s, it underperformed a little bit. And there's been times of underperformance as well. You start seeing those like headlines where it's like, oh, has Warren Buffett lost his fastball and things like that. But everyone tends to give him the benefit of the doubt. I don't know if Greg Abel will get the benefit of the doubt as much. And so, that might just be a valuation thing, and maybe many years from now, after the Buffett trust has kind of wound itself down, it could impact like ownership or anything like that. But I don't know if it's going to be any material changes. I think things will be more or less okay. I mean, it's not just Greg Abel. You have Ajit Jain, who's basically he's not just head of Geico. He's the head of like all insurance underwriting. And then you have Todd and Combs, Ted Weschler, who kind of are all like lieutenants who go in and would like fix businesses. He did mention in the letter too of like Todd going in and trying to like fix Geico. It was something that I remember you and I heard at the meeting 2 years ago, that Geico and some of the insurance was not performing as well. But this year was doing very well. So he gave Todd some kudos there, and then Ted Weschler obviously doing some of the investment stuff as well. So it's a little bit more of a team effort, I think, now with and it'll be much more prominent team effort with Warren Buffett gone. But yeah, I think we'll be fine for a while with Greg. I don't think it's not like, oh my God, I need to sell this thing when Warren's gone.
Yeah, no, I feel the same way. I don't think we'll really know till it happens and we see what goes on. But one of the things that I think about a lot as it pertains to Buffett, and even with Munger when he was still around, and the company generally, is I have this one view of their success that goes something like this. They're not necessarily, maybe the majority of their success is not based entirely on investing prowess. Maybe what it's actually based on is just top-notch mindset, patience, not getting caught up in the fray, seeing the big picture. So to me, I like to say in my day job that everyone's replaceable, especially when people start to view themselves as being irreplaceable. And I think if you build a culture in any system, a business, wherever you are, then the people in it can be a little bit more interchangeable. And look, I'm not saying the next person's going to come in and be just as good as Buffett, but what it does seem like he's doing very carefully is bringing in the right people to build the right culture. And he talks about culture a lot, so that when he isn't there, the culture stays. And I think if the culture stays and you have people who are, just good investors, like I could see a world in which Berkshire 25, 30 years from now looks a lot like Berkshire does now. Maybe some different types of investments, right? Like, Warren Buffett has a circle of competence and everyone's is different. So could I see them making either wholesale purchases of companies or minority investments in slightly different sectors? Like, does it become a little bit more tech heavy of a company just because it's 2025 and it's not going to be run by a 95-year-old man? Like, who knows? But if all of those kind of culture principles are still there in terms of like not overpaying and buying a wonderful business at a reasonable price rather than a mediocre business at a great price, right? If all those sort of, old school Warren and Charlie quips that we all repeat stay, I don't know that there's any reason for panic until such a time where we might see, something that causes panic, right? Like an actual bad performance over a long period of time. So yeah, I'm optimistic that things will stay pretty similar, and maybe we'll get a dividend. Who knows?
That would be the biggest announcement change. And to that point too, it seems like Greg has certainly had plenty of time of apprenticeship to learn all of those skills. So it's not like he's just being brought in for anything new. I've got a couple of questions that I see, not necessarily Berkshire related, but things I can get to.
Sure.
Is there anything that's itching for you right now, or do you want me to take one?
Yeah, take one. I mean, I was going to dive in a little bit more into ServiceNow since I mentioned that, and it was an older question, but you can go do one of yours.
Sure. Well, 19 minutes ago, Ron H. asked about Easterly Government Properties. The ticker is DEA. As the name suggests, DEA, it has a lot to do with government properties. They are a prominent landlord to the U.S. government with a lot of FBI, VA hospitals, a lot of municipal and state buildings as well, courthouses, basically a lot of the property outside of DC, especially regional offices, things like that. It's a very intriguing business. I mean, certainly for for decades, being the landlord to the government was a pretty good business because they always paid their rent on time, and the contract structure for them was relatively favorable, and like it covered a lot of the costs. The tenant would pay like taxes and a lot of those things, and there was some pretty standard like escalators built into them that it made it worth the landlord's while to rent to the government. The yield is quite high today. Yield is about 10%, and the reasons being is, number one, it is a pretty leveraged business. They took on quite a, even by REIT standards, which uses a lot of debt to pay for real estate. I think that their leverage is considerably higher than others. The original premise being like, well, we have such a stable customer in the U.S. government. we can afford to take the leverage because there's much less variability in our revenues. We don't have to worry about vacancy nearly as much as somebody that's, leasing to businesses or things like that. So, you could see why management would justify it. But with the other thing that's, when you have high debt loads too, the problem is when you have major significant changes to interest rates, that can, sap cash flows pretty quickly. And I think that has been another part of the equation here is, from 2022 to today, we've gone from a time where interest rates were quite low in pretty much the entire post Great Depression time, or Great Recession, time, up until like the post-COVID supply chain and inflation spikes, where we saw these big increases in interest rates. And so, that's obviously going to sap cash flow. And when we're using quite a bit of leverage already, things like that, cash gets a little bit thin. They haven't increased their dividend anytime recently. So I think there's just that position, like it's a little financially tenuous, and then we'll just throw a little bit of extra uncertainty involved with a lot of government efficiency measures these days, where there has been, veiled discussions or veiled proclamations at, ripping up contracts and things like that and renegotiating contracts. The idea being like, maybe those contracts with the US government weren't the 100% bulletproof ironclad contract that they thought that they used to be, which could, just add a little extra uncertainty. So far, I haven't seen enough not uncertainty that I'm like running for the exits with this business. I should mention that I manage an account that is invested in DEA in Easterly government properties. So, and I haven't found a material reason to change that position yet. Although I am going to be much more intently focused over the next couple of quarters to see what happens with refinancing of debt, as well as if there's any growth in the pipeline from new leases or things like that can kind of help build up a cash cushion again.
Yeah, it's funny that I don't know that company at all, but it's interesting that you mentioned the government contract aspect, because that's actually part of what I wanted to talk about in answering the question from a week ago by AI, who asked, at what price would you start buying ticker NOW, which is ServiceNow? So it's interesting. That's a company I just the other day listened to the earnings call, and I referenced it as we were talking about the managerial styling differences between the CEO of ServiceNow and the CEO of Berkshire Hathaway. And so if anyone doesn't know ServiceNow, it's a platform of softwares that help businesses run like the back end of the business, right? HR software and IT stuff and things like that. And I've been saying for a while now here on Fool24, as we talk about AI just generally, that I'm interested in following companies like ServiceNow because they have the perfect product to start implementing AI agents or AI assistants within it to help take away some of the boring jobs we don't want to do, help people be more efficient so that we can do the jobs that only humans can do. And they're doing that. They're adding that into their software. They talk about it a lot. And I think, that's something to watch with this company to see if it becomes, a growth driver, a revenue driver, a profitability driver that they think it will. What was interesting about this particular earnings call was the multiple call outs to the current administration and the current president in terms of basically saying, hey, we save companies money. And the reason they're doing that is because they have a lot of business with the federal government. There's agencies in the government that use the ServiceNow platform. And you could very much hear management trying to say to all who would listen, our contracts are good, stick with us, we save you money, we save you money, we save you money. And that stuck out to me like a lot, because that has not been, they've mentioned having government contracts in the past, but never that explicitly, never that pointedly. So I'm very interested now in kind of following that aspect of the story with the company to see how that shakes out over the next several quarters. As for what price I would start buying this company. So this is a stock that is always expensive, and because the company always does a great job. I've said before, I have these companies where every quarter they report, I fill out my spreadsheet that I keep, and it's just a constant up and to the right with almost every metric, just steady growth, mid-teens, mid-20s, whatever it is, not fluctuating, not choppy, just killing it quarter after quarter. That's how ServiceNow has been ever since I've owned it. And I've owned it it's one of my oldest positions, which is for me relatively short amount of time. I've only been buying individual stocks since early 2020, but I've tracked it for a while now. And it's just one of those companies that just impresses me quarter after quarter. It's always usually pretty expensive. So I've taken a dollar cost averaging ish approach with this one, right? This is not a stock I've ever like made a huge buy into. I've never taken a big bite out of the apple because it is always expensive, but I've tried to look for times when it slips, has a quarter that misses an estimate here and there and drops a little bit. So I've not added to it in a while because it's gotten even more expensive than when I last bought it, not by price, but by valuation metrics. So now I'm interested to see if there is any negative impact with, government efficiency and contracts being canceled or programs being cut and things like that. And if they can weather that storm and there's a buying opportunity that results from it, it might be something to think about. So that's how I think about that company.
This is I think a nice one that we can both hit because it's a little bit more, we'll call it, I wouldn't say personal, but a little bit less about individual stocks. But Sadaf asked about 24 minutes ago. Can you talk a little bit about your risk management strategies at the portfolio and individual stock level? I think it's an interesting question because like often when we think of like risk management strategy, when you hear things like that, it calls to mind like hedge funds and things and like institutional investors who are doing like complex trades or derivative trades or things like that to like hedge risk at the portfolio or stock level or something like that. In obviously individuals, most of us don't do that, or certainly, I don't have the time to sit there and try to hedge every position in my portfolio or anything like that.
Right.
So I think at least for the individuals, I'll start with the individual stock level for myself, and then I'll let Jeff go when I get done. Individual stock level, it just kind of comes down to risk. Like risk management is just research. Like the best you can do is to just kind of, number one, probably do a little extra research on the front end. I mean, it's kind of going back to the Charlie Munger is, you do with buying stocks, you do all the work early and then you just kind of sit on your ass or on your butt. Sorry, man. I don't know if we can say that. That's the problem with Charlie Munger quotes is sometimes you might say something you're not supposed to on live television. So at least at the individual level, I think it just comes for me. I guess my risk management tool is just research. I tend to not invest in anything unless I've read the 10K. I've read the proxy statement. I've read a couple of years of financials. I'll probably read a transcript or two and maybe an investor presentation to go from, not just what it's been, but where it's going. And that's like, for me, the bare minimum for anything that I own in my portfolio. And then if I'm still like uncertain at that point, it almost gets to the point where like, maybe I should just move on if I do this and I'm still uncertain. And then at the portfolio level, I guess, if you will, it's just kind of a diversification tool. I've mentioned it here a couple times. I have about 40 stocks in my portfolio, and anything on the publicly traded side of my portfolio is more than like 4 or 5% of my total invested net worth. And so there's not a huge up and down portfolio risk with any particular company. And so in that end, like no single company is going to certainly break me. And I would say I'm not the most diversified. I certainly don't have a lot of exposure to most of the stocks that people talk about, large cap tech, things like that. I have probably a heavier concentration in cyclicals and energy and real estate than most, but I do try to, at least try to keep a relatively even balance. I have found myself often looking at my portfolio and going, I have way too much oil, and then having to try to wind that down with a series of purchases after that.
Yeah, I'm not too different. I think at the individual level, I think of it, I'm a little bit different than you in the sense that I don't do it. I'll buy something more quickly, at least as an initial purchase. And that's what gets it in my sort of rotation of learning. So I guess you could say I'm a fan of like the starter position, for example. But I'll sometimes hold that starter position for over a year, right? I might buy a couple $100 of something, and then I spend the next year, reading the quarterly reports and the annual reports and keeping my spreadsheet and listening to earnings calls and all that kind of stuff. So I guess I'm doing the same thing as you on the learning aspect of things. I agree with you that that's a good strategy for the individual stock level. I buy a little bit first and then use that to decide when I add to build the position out. But I sort of came into the stock buying part late in my investing life. So I already had a 20+ year history of index funds and ETFs and things like mutual funds, things like that. So I'm actually probably less risky in my individual stock portfolio than I could or maybe should be, considering what a small percentage of my overall invested wealth it is. I sometimes say I should probably be taking some bigger swings at that individual stock level because of that. I think if I were a person who were an entirely individual stock investor, I would probably think of it more like, what's the broad index fund version of individual stocks? And I'd have a lot of those to sort of like be the ballast in my portfolio. I would own a lot more Berkshire Hathaway as an example, right? I would view that as a safe-ish, less volatile stock to sort of be a larger position in my portfolio. And then I would take a bigger swing with a smaller amount of that. So I think that's how I think of it both ways, at a portfolio level and an individual level. Position sizing, taking small steps when I'm still in the learning process. And I was talking to a friend of mine recently who wants to get into investing a little bit more. And, I don't give advice when people ask me questions. So I said, if I was starting over, I would probably just start with index funds entirely and sort of pivot, into stocks as I felt comfortable and to the degree that which I wanted to learn about them. And I think if you're a kind of person who doesn't want to learn about individual stocks, then keep that percentage more heavily weighted towards index funds makes sense to me, right? Because with stocks comes the need to learn a little bit more. So that's how I think about it. That's how I handle it in mine.
A bit of stupidity insurance to start, but I do have a quick follow-up question because I'm itching to know when that same person asked how to get started, what was the first book you recommended?
We actually didn't go down the road of books because the question that started the conversation was more about this is a younger guy who is a freelancer, so inconsistent income, and just said to me, all right, I've maxed out my Roth IRA. I don't know what to do next. And that was the start of the conversation. And it ended up landing in a place where I think ETFs and index funds, set it and forget it, is more his vibe. So I don't know that he's going to go down the road of reading too many books. I think he did tell me about one book, but it wasn't one that I'm familiar with. So I don't want to say anything positive or negative about it. So we're going to have more conversations. So we'll see I have a couple I would recommend. I mean, I like any of the Peter Lynch ones. If you're going to go down the road of individual stock investing, I think those are great. The
first book I would recommend to anybody is one of the Peter Lynch books.
And the reason I didn't was he wasn't really expressing a desire to do individual stock investing yet. It was more just the bigger picture kind of stuff. And I don't know, man, everyone says that The Intelligent Investor is like a bad place to start. That's one of the first ones I read, and it was dry, like you'd expect any book that was written that long ago to be. But maybe just because I was such a nerd about it at the time and really interested, I liked it a lot. I thought it was interesting. Oh, yeah. But I could see how some people maybe not the right place to start. I get it.
Oh, it's dry reading. Benjamin Graham's a very insightful person, but I wouldn't call him the Bill Shakespeare of investing writing. That's for sure. I'm going to hit a question here and real quick, and then I'm sure you got some in the queue that you're seeing as well. Ed actually asked 4 minutes ago, XPLR. This year, big drop in elimination of a big dividend. Do you see a future with this company, and do you think this can be a turnaround stock? So for some people who maybe might not have ever heard of XPLR, well, it's because it's a company that just actually changed its name recently. This used to be NextEra Energy Partners. This was the subsidiary of NextEra Energy, kind of like one of the like whole, the entities that like held a lot of its like renewable resource development projects, solar, wind, what have you. Basically what happened is earlier this year, they decided to change their name. And with that, they suspended a dividend that was at the time, I think, in the 14 to 15% range for quite a while. It might have even spiked even higher. The market was more or less telling the guys, I don't think we can, we think you need to cut your dividend. And well, they did. They suspended it. Well, they try to repair their balance sheet. As far as the future of the company, do you see it as a turnaround stock? It has a lot of work to do in terms of fixing its balance sheet before we'll see a material turnaround in this business. In addition to the current debt that's on the portfolio, there's a lot. The company had a lot of convertible debt that it was converted at a much higher price than what the stock was trading for, and so when that happens, it means it stays as debt, and they have to refinance it via debt versus it converting to equity. As a result of that, a higher debt load, more interest payments that they didn't necessarily think they were going to have to pay, and the growth trajectory of this company has been altered significantly because of higher interest rates. So there is a possibility of this turning around someday. Solid contracts on renewable energy in a time when we're probably going to see energy and electricity growth in the United States, pick up materially for the first time in decades. So having assets in this place is going to be good. I hope some of those contracts have some inflation adjustments built into them, because this is going to be one of the rare times where that's very valuable. So those things are in place and can lead to repair, but there is a lot to repair, and that's what makes turnaround so challenging. You see like a lot of turnaround candidates, and they're so early in their turnaround component that maybe the business deteriorates a little bit more before it actually gets better. Stock can drop considerably before it starts to like finally even out. And I think that this company is still very much early in its journey of fixing what is wrong. It could be a good turnaround candidate further down the road if valuation stays low and they can materially repair a lot of those things. But until I actually see the action of, or see those things happen where it's in a better place and it starts to build back that trust with investors before, like, I don't know, the stock soars, then I would revisit it. But I would like to see actual things happen first.
Would you say that you said they have a lot of work to do to repair their balance sheet? Do you feel like that's going to be even harder just because of maybe less tailwinds in that space than maybe we would have thought there were going to be like a year ago?
It's certainly possible. I mean, I think that on the development side, solar so far, there's been a lot of bluster in terms of, permitting for wind that would, kind of make that a less viable option. But like permitting, contracting, getting solar projects, especially at the utility scale, which is mostly what they're going to be doing here, I haven't seen anything that's going to materially change that. And I think, there's this talk about nuclear. There's a lot of talks about like how we're going to facilitate or, manage all this demand growth. The two things that we can deploy really fast and actually get like additional capacity on the grid right now is natural gas and solar. Those are like our fastest to market options. And if we're going to see rapid increases in electricity demand today, we're probably going to have to rely on those two a lot to meet that before nuclear or anything like that can be built out. And so I think there's definitely opportunities for growth in solar, and them being profitable. I think it's just going to be a lot of like them signing contracts at the right rate, and once you have that in place, it should work. But again, that is only going to be used for like debt reduction for quite some time,
Right?
And so That's the thing that always gets me. It's like, well, that's great, but like 3 years later, we're still doing in debt reduction phase. That it can take a while, especially when the cash profile looks pretty thin.
Yeah. Yeah. When that's the one thing you have to focus on, it can take a while, and it can make all, it's like you had to wait, and you just have to wait for all the other stuff, right? Yeah, they have to get that in good shape first. All right. We had a question from Marie about 16 minutes ago. It says Tesla is dropping like crazy, plus the volatility is like a roller coaster. Do you think it is headed back to the 52-week low? I don't know that, but I think it's worth talking about Tesla just as it pertains to its valuation and its price, because this is, I find this to be a very interesting thing to talk about as it pertains to the company. So just for context, it's down, the stock's down about 16% year to date, 18% just over the past month. And here's what I've always struggled with, Tyler, when it comes to Tesla. I've always tried to think of its valuation as a sum of the parts. But my issue is that many of those parts are, kind of hard to wrap your fingers around, right? So let's start with the car business, right? That's obviously the main thing we think about when we think about Tesla. You can make an argument it should trade for a premium to other car companies, because for a long time it had a significantly higher like operating margin and things like that. That's come back down to earth a little bit, but you can convince me that they are worth more than the other legacy automakers. Okay, fine. But it is not priced like even a company that is slightly, ahead of its auto competitors, right? Because there's a lot of expectations built into the stock that are around the big things that the company talks about: autonomous driving, full self-driving as they call it, the robots. Will there be another car that's even cheaper and more affordable for more people? The AI stuff, like there's all these other things that are built into that price as well. And then there's the whatever percentage of the valuation that gets attributed to Elon Musk as a leader of the company, right? He's a polarizing figure, but he has done pretty well at making companies come from nowhere and become successful, right? Whether it's Tesla or SpaceX or anything like that. So I don't know, like with him being in the news so much, if that's going to change like that aspect of the valuation in a way that like we can't predict. It's one of the reasons that although I technically own it in a portfolio I manage for someone else, because it was a stock that person wanted to buy, I don't, like, when I think of like what I own for me, I don't own it. And it's kind of because of that. Like, I just can't wrap my head around the valuation enough to like understand when is a good time or a bad time to buy the stock, because this sum of the parts way of thinking about it just makes it difficult for me. So now tell me where I'm wrong.
I don't know if I want to say that you're wrong. The thing I wanted to focus on in the question is the volatility part, because it's, it does seem like almost, I don't want to say counterintuitive, but eyebrow raising, or that's peculiar sort of question, is how a business as large as Tesla can be as volatile as Tesla is. And that,
and I think that's because some of those sums of parts are things you can't
right,
grab. They're based
hard
on
to
hope
value
and expectations and maybe.
Yeah. And just a component to add to this as well. And we can discuss it as much as I don't know how much merit you want to give to this idea, but Tesla as like a holdings, most companies can be divided up into institutional shareholders and retail or individual shareholders. The percentage of people that are of retail or individual investors that own Tesla is considerably higher than institutional investors. And retail investors, we all, I'd like to think that maybe all of us stock market junkies who are sitting here on a Sunday talking about the volatility of Tesla stock may not necessarily be the people I'm talking about here, but for the most part, retail investors tend to be like weekend, day traders using a lot of like some of these new exotic like zero day trade options and things like that. All of the things that tend to make a stock more volatile. lots of short interest, lots of things like that, which, for a company of its size is peculiar, and perhaps why you see so much, not just volatility over a few months, which I think would be to your point of like the really hard to value components, but also in the day to day, it has a lot of these, people doing side quests with its stock in various ways. And yeah, I do agree on the valuation part, because there is a lot of hard to value things because we don't have an established market for them already. We don't have an established market for humanoid robots and when exactly they're going to come to market. We don't have a adequate market to value autonomous driving because we don't really have an assembly for that in the market today. And we're not 100% certain when it's going to come to market, because this is something that's, I think, has been 2 years away for 10 years now. There's just a whole lot of components like that that when you say valuing, you're not valuing the business itself. You're valuing management's ability to deliver that business. And with with Tesla, it has done things sometimes on a longer schedule than originally anticipated, and certainly the full self-driving one can take much longer than originally anticipated. I think there's just like this. The valuation is built in a lot of confidence that Elon Musk and his team is going to deliver that, and perhaps the additional volatility seems to go that Tesla it doesn't appear, at least by my opinion, that it is his primary focus today. And perhaps if it's not his primary focus, is that going to change the timeline on a lot of these developments?
Yeah, that's a really good point. Like I've thought a lot about where his focus is as well, but I've not thought about it quite through that lens of like, does that change the timeline, right? Because is he the one hitting the gas pedal on things like full self-driving and on autonomous robots and things like that, right? And if he's not there to hit the accelerator, like my car analogies here, Tyler, if he's not here to hit the accelerator, like, does that mean that someone else doesn't? And then all of a sudden these things are now further out into the future? That's a really good way to think about it. So we got a question from Sadaf 12 minutes ago, and I'm happy to try to answer it in the way he asked, but I don't think about my investing this way. So he asks, what is your favorite S&P 500 stock to buy at current price? So I don't think about if a stock is or is not in the S&P 500 when I make a purchase. So I'm going to answer this a slightly different way. And I'm not going to say what's my favorite, but I'm going to say, like, I'm going to define favorite by here are the last ones I bought. and I'll talk a little bit about why. So like the most recent investment I made, I can't talk about yet because I made it late last week. But before that, I did a thing that I've been dying to do for a really long time. And that's I finally bought some Costco stock. I do not know that this is the right price to buy it at. I bought it thinking it's too expensive, but I've said a bazillion times on Fool24 and in other places, I'm the kind of person that needs it in my portfolio before I will start like getting it into my like rotation and routine of like learning more about it and tracking it and things like that. So this was a very minor starter position for me. I hope to buy it at better valuation points moving forward. And I think this is in the S&P 500 actually. And it just feels like one of those companies where every time I go to a Costco, Jim Gillies says this all the time. I want to text someone and say I need to own Costco because it's just a remarkable business. And I believe I don't have the S&P 500 like list in front of me. I think they're in it. The purchase I made before that, and then I'll turn it over to you, Tyler, to answer this in whatever way you want, is actually Mercado Libre, which I know is not in the S&P 500, but it's been a favorite of mine for a long time, for a few reasons. One, it's the same sort of stock for me, at least in terms of results that I was talking about when I was talking about ServiceNow, where every quarter rolls around and I look at the results and I'm just like, everything looks great. I mean, I know there's risks with the company. It's not perfect. I think that's part of why it's not been as highly valued as some other things that I own. But I've looked at that as being reasonably priced, at least for a while now. So that was one that I bought earlier in February and had a good earnings, I thought, and a good, for me, reaction to the earnings. I think it was up 10% or so after it reported. So those are two that I think are favorites of mine. One that I think is actually a decent valuation at today's price, and one that I actually don't think is, but I bought anyway. Because like I said earlier, I'm a fan of the starter position. What about you? I'm guessing you don't think of, is this in the S&P 500 when making decisions either, but I'm curious how you want to answer this one.
I don't even know if they're in the S&P 500, and I should. I think I did a quick scan of my portfolio, and I was like, I think I might only have one company.
Yeah, I would
in
put
my
it
portfolio
probably
that's-
one or less. That would
Yeah,
be my
I
guess.
think the only S&P 500 stock that I have in my portfolio is Berkshire Hathaway.
Well, you know, yeah.
I'm looking at the list of S&P 500 stocks and like started at the bottom and been working my way up. I'm like, man, these are giant. I don't know if I own any of these. So I don't really follow a lot. Like I don't know what all the constituents are in the S&P 500, especially you get down into the 400s and it's like a lot of, I mean, it's companies people know, but
Yeah.
not necessarily like, oh, I didn't know that it was part of the S&P 500 or something like that. So it's hard for me to do that to make this call because so few of the companies that I follow intimately or the ones that are in my portfolio or anything I've made a recent purchase on is actually even in the S&P 500. So I'll say my favorite one's Berkshire because it's the only one I have.
Yeah. Well, and it's funny when, as we were talking through this, I had another thought pop into my head that I think is relevant to this conversation because I had such a head start in investing with index funds and mutual funds and things like that. I actually went through my portfolio, I don't know, maybe 7 or 8 months ago and ended up selling a lot of the large cap tech stocks that are at the top of the S&P 500 that I owned. Not all of them, but a lot of them, even though they were doing great for me and I didn't have any less conviction in the business. But I actually took the time to go through my all my accounts and all my holdings and realized that I actually had like more exposure to those companies than I even wanted or needed. And to have them also in my individual portfolio felt like I could allocate that money to maybe some different ideas. And I was skimming through the list of S&P 500 companies earlier, and it reminded me that I used to own more, but I've used that cash for other things because I already have so much exposure to them. So I think that's worth thinking about for people who have both ETFs or index funds, especially ones that track the broader market and are stock investors, just to be mindful of how much exposure you actually have. I had multiples more exposure to like Apple, for example, than I realized until I did that exercise. So I ended up selling that as an individual stock. I still have plenty of Apple. It's just a little more hidden than when I had it in my brokerage account as an individual stock. All right. Anything else you want to grab here, Tyler?
Yeah, there was one because it's a slight callback to the Berkshire Hathaway letter a little bit, and I'm trying to see. I was trying to find it because it was related to like the stuff on taxes and things like that because it was it's Sadov's question for about 28 minutes ago. Speaking of letter from Buffett, do you see any warning signs on USD? Which I'm assuming he's not talking about this really, really small, obscure semiconductor ETF because there is a ticker USD that is that. I'm assuming
I took it
he's
as
talking
dollar.
about the
I took it as US
dollars, just in case. But there was just this one section in the he was talking about how much Berkshire Hathaway had paid in taxes, and there was kind of like a small line about I can't if I remember. It was basically like the stewards of keeping a stable currency and a kind of like a stable sort of like underpinning of the business. Sorry to make it really, really bad television while I try to find it and make that quick reference, but it was kind of just like this idea of like price stability, keeping a constant currency, keeping a not trying to see like over rapid price changes in the US dollar or anything like that. And so on a relative basis, strength relative to other countries' currencies, I can't really speak to that too much. because that can go in a whole bunch of different directions because you're often talking about relative to one other country or the other. But just taken at face value, and I don't want to get too political with any of the statements, but there are some of the proposed policies for that have come out, whether it be tariffs, whether it be lower taxes, or I'm trying to think what was one of the other ones, trying to keep interest rates down while using tariffs and things like that. These tend to be pretty inflationary ideas. Oh, the other one I was going to mention too is labor. If you do have a large crackdown on immigration, reduces labor supply. All of these things are indeed inflationary, which, should, in theory, weaken the currency. So I think that's maybe what Sadaf is referencing into here. I don't warning signs, no, because a lot of things that have been, like I said, they have been said, they haven't 100% enacted yet, and or at least enough that it would be a material change to this. And also, it's kind of just like a table stakes thing. I don't know how many of us are also like hedging currency risk in our portfolios by doing paired trades with euros or something like that. I probably doubt it. So I don't know. It just tends to be one of those table stakes things. And I don't know, like, how, even if I did have see warning signs in the US dollar, as the question would insinuate, it's like what I would do to mitigate that in any way.
Yeah, I mean, I understand the risks that are out there when you hear people smarter than you and I talk about these kind of things that could happen to the stability of the dollar based on like if our economy collapsed or something like that, right? Like there are scenarios out there, doomsday scenarios that like I think are worth at least being aware of. But the place I see talk about currency fluctuations in the US dollar is more on like earnings calls when you'll hear a management team say something like, earnings growth was 8%. If not for fluctuations in currency, it would have been 10%, right? You see a lot of that or sometimes the other way, right? We had a 2% benefit from currency fluctuations. I've always just said, my thinking on that has always been, that's going to shake out in the wash because we are all trying to be long-term investors here, right? And, if someone's trying to trade in and out of positions, then maybe those couple percents of revenue growth make a difference. Different ball game, one that I'm not playing. But that's as far as I've given thought on U.S. dollar as it's relative to other currencies. So I don't know if you have an answer to this, Tyler, but we can skip it. If not, Vihan asked about speculative investments that have gone well. He phrased it as your cost base is compounded to the moon, or and if you've had any bumps. I have to be honest, I've not been investing in individual stocks long enough to say I really have a speculative company that I bought that really skyrocketed. I've had some good investments. Some investments go well on a percentage gain basis. I've talked about them before, but I wouldn't call them speculative unless you consider buying Nvidia in 2020 was speculative. But so I don't really have a good answer to that, but you've been doing this a lot longer than I do. And you certainly buy companies I would say are more speculative. And maybe that's just because it's not in my circle of competence, but I don't know if you have a place to go here as we wrap up.
Well, it's funny because I would say I'm an atrocious speculative investor. I'm trying to think of the times when I think of speculative, I think of very, very early stage, maybe pre-revenue, maybe just revenue is barely existent, not profitable, trying to get its start. And businesses like that, at least me, I have pretty atrocious track record in that. Like most of the things that if I go into obscuria, it tends to be companies that have established track records of profitability.
Right. So you're going obscure, but with a margin of safety.
Yeah. And so I can, the most, when I would say speculative is also too, is maybe I have incomplete information with this and I don't really know what I'm doing, but yeah, whatever. And I think the most speculative thing that actually worked out for me was I think it was a Motley Fool recommendation back in 2011 or 2012 or something like that. It was NXP Semiconductors, which, I think on the semiconductor industry these days is probably one of the more, not on the bleeding edge of technology. I know they do a lot of like near field communications and things like that. And I think they supply the automotive industry a lot, which is not like the AI chips everyone's demanding for, but holding it for as long as I have, like 12 years, it's, I think 1,200% gain, which has been quite nice. So I would say that was the biggest one. And for any bumps, it was just like, for me, it was always ended up being such a small part of my portfolio that it just kind of stayed there. And, it's a nice reminder of what can happen when you hold something for a very long time and sometimes not even think about it. Even if it hasn't it has helped, but it hasn't like been a material, like wealth compounder for me relative to the rest of my portfolio.
Yeah. All right. Well, with that, we are at the top of the hour, a little bit past it. We have Jose and Neil coming in now, and they'll take you through the next hour. Gentlemen, good to see you. Tyler, thank you for spending the 2 o'clock hour with me, and I'll see you all later.
Yep. Thanks, guys. Have fun.
Thanks, Jeff. Thanks, Tyler. Hey, Neil, how's it going?
Hello, Jose. How are you? How's the weekend going?
Pretty good. And good afternoon to all the fools watching. And like always, if you have any questions for us, make sure to check out Slido, passcode Fool24. Neil and I are going to spend this hour talking about tech and semis. So definitely, yeah, any topics around there, any questions around there, feel free to let us know in Slido. But Neil, I mean, this week coming up is going to be a very important week, I would say, for the tech and the semiconductor market, as we do have NVIDIA earnings. Now, before we take a closer look at maybe some NVIDIA earnings preview, is there anything else outside of NVIDIA earnings that, as a tech investor, you are maybe excited for? I believe there might be some other companies reporting, but not sure. Right now, I'm going to be honest, Neil, my brain is just working on NVIDIA, and that's it.
Yeah, no, I mean, when you have a week where NVIDIA, that small AI company reporting, I think all the attention goes to that. But I think we have Snowflake, Salesforce as well. So pretty big companies in the software space. And then, of course, we have Supermicro's deadline, right? Supermicro's deadline on February 25th. I mean, that's going to be an interesting one as well. But of course, all eyes on Wednesday on NVIDIA's earnings report.
Yeah, Neil. So I'm going to take a question here that just came in from Let It Ride about a minute ago. And Jose, I think you were talking about digital twins when talking about Unity earnings. And I believe I mentioned digital twins yesterday. I forget who I was. I think I was with Danny. And he was just wondering more what I meant behind this digital twin market. So digital twins has actually become something that I got a little bit more excited about, Neil, if I'm gonna be honest, this past 2 days. And the main reason, I just watched an interview with Jensen Huang, and I forget who the other gentleman was, but he is the CEO of a company called DDN. And in this, it was about a 20-minute interview that just happened. And in this 20-minute interview, they talked about first kind of the DeepSeek drama and how Jensen kind of really, I think it was the first time we've seen him kind of really publicly address the DeepSeek issue and why he believed the market has it completely wrong. But then the second thing he really talked about was kind of the Omniverse. And the Omniverse is kind of this place where it's being built, the digital twin, these digital twins. And I always kind of saw this digital twin as, okay, pretty cool. It's going to help companies kind of maybe become very efficient. But I never really, I want to say, probably never really grasped how at least Jensen was kind of seeing this digital twin. And Let It Ride, it's going to all tackle back to Unity, because Unity would be one of the players that would help kind of like with the I would say the easiest way, maybe like the content creation of the digital twin. But Neil, Jensen, when he talks about AI, he says AI, where we're at right now, is kind of the first stage of it. And that first stage is creating the data that we know in our real world life and making it into this digital data that's digitally intelligent. And the way he talks about that is, right now, us as humans, we understand how gravity works. We actually see it in real world. And how can a computer simulate this, right? How can they simulate this type of data? And this is what artificial intelligence is doing with everything. It's grabbing all the data that we know and kind of converting it into what he calls digital intelligence. So in the future world, and again, this is going to sound very sci-fi, the way he believes digital twin is, let's say you are a pharmaceutical company. You have all this data of how maybe a certain drug works with, reacts to a certain human being who might be this size, who might be this weight, who might have this type of blood type. Now with artificial intelligence, we can convert that data into digital intelligent data where inside this digital verse, maybe I could say the metaverse, but whatever, it becomes known of what happens when a human with this type of attributes mixes up with this type of drug. So then a pharmaceutical company, which has all this data, can create digital twins and run various drug simulations with vast amount of compute power in these digital twin worlds and be able to test out 10, 15 drugs at once and then find the final answer that has the best, not a guaranteed, but the best percentage or probability of being correct. And now they save multiple years, multiple billions of dollars in choosing the wrong drug, but because they have this intelligent data, that digital twin reacts almost identical to how the real world would react. And that was just one example in the pharmaceutical world, but just in any type of business, there might be a world where you're just running simulations over and over and over and over again to try to find the best results. And obviously, Unity would work with the content creation side in this digital twin world. But I think that market is going to grow. I don't know when. It's one of those sci-fi stories, in my opinion, Neil. But I'm starting to see the reasoning why companies would want to invest in a digital twin of themselves. Anything there, and any thoughts there, Neo? And sorry for my rambling, but it was just something that has gotten me really excited after listening to that interview with Jensen.
No, I agree. I think Omniverse was announced on the big stage, I think 2021, even before the ChatGPT moment, I believe they were talking about that. With Unity, it's the game side of things, but I think they also had a partnership with Volvo, if I'm not mistaken. And they had something with regards to digital twin. They could basically put the vehicle in the digital environment. We've seen that with factories as well. You can see that with insurance, for example. Lemonade, an insurance player, uses AI agents, synthetic AI agents. You can run multiple scenarios. You can have more personalized insurance, right? Because now, even still today, right? You and me, we're probably going to get the same quote, same insurance. But at the end of the day, you're Jose, I'm Neil. We should be getting different types of quotes, different types of insurance. I think we're just at the start of this huge revolution, whether it's us two, personalized stuff, whether it's insurance, medical stuff, digital twins for factories, simulations for space, whatnot. I think this is just the start of something much, much bigger. And of course, Omniverse, digital twins, Unity, NVIDIA, and maybe some other players as well will play a pretty big role in all of that.
Yeah. And to me, Neil, I think the thing that really got me excited about this, and we've heard about that kind of digital twin, like you mentioned, for a very long time, is I never really understood the way of how the AI market was going to play out into this, but kind of having AI make our data that we know really kind of be simulated in this digital environment. It sounds simple, but it's really not. Like, how can a computer really kind of, and again, back to that pharmaceutical world, be able to know the patterns of how a human might interact with certain drug based on whatever attributes that they might have, based on whatever kind of sickness that they may have. So again, at the end of the day, it seems like no matter where we're headed with this AI market, it's really going to be the companies that have vast amount of data that are going to be able to probably win the most early on. Obviously, that could change later on, but at least right now, the ones that have strong data, data is definitely very crucial at the moment.
Yeah, we've seen that also with the autonomous players, right? Training on real world data and not just synthetic data. Although we did discuss it, I think, in the past about NVIDIA, Uber training on maybe synthetic data versus a Tesla, a Waymo that has more and more real world data, but it's going to be quite interesting to follow and see what happens in the future, because I do think that at one point it will be synthetic data, right? You would have collected so much real world data and all the rest will just be synthetic data. And that's when I think we're going to see multiple winners, or players, should I say, players.
Definitely, Neil. Now, Neil, we got a lot of questions here. I don't know if you want to jump into one. And just in case we don't get any questions, just want to throw something out. Is there anything that got you real? I talked about that interview of Jensen Huang that I watched. Is there anything in this past week, Neil, that might have gotten you maybe really excited about an investment that you own, or maybe really excited about kind of like a market opportunity that you might not be invested, but are kind of curious on?
This past week, to be honest, no, not really. Not really. This past week has been, it has been quite volatile, right? Especially the last day on Friday, it's been volatile. But other than that, no. I'm an Uber shareholder. I think you are as well. So we've had that comment from the Uber CEO saying that he did talk with Elon Musk about a potential, Tesla listing on their robotaxi on the Uber platform. That's not going to happen at the moment. Okay, fine. I still think that Uber is going to play a very important role in the future as that distribution channel. But other than that, my eyes are on the next couple of days. We've got NVIDIA, we've got SMCI's deadline on the 25th. I think, Axon, Home Depot, Salesforce, Snowflake, they're all reporting the next couple of days. So it's going to be quite interesting what happens.
Speaking about Uber, I don't know if you read it. I still have yet to read it, but I saw on February 20th, ChatGPT and OpenAI, Uber enables outstanding on-demand experience with artificial intelligence. I don't know if you read that press release. It was a press release on OpenAI side. So wanted to see if you read it, had any information about it.
No, that must have skipped my my feed.
Yeah, it was pretty random. I feel like not many people have, even on X, I didn't see much people discuss it, but it was just one of those posts that I saw ChatGPT just randomly put out there. All right, so that's probably something I'm gonna, probably both as being shareholders, read throughout the upcoming, maybe after this live stream.
Yeah, plus I believe on Tuesday we have a autonomous and robotic specific session going on, so that will definitely be touched on.
Neil, I'm gonna send this question to you first. 307 Fool, about 8 minutes ago. Risk reward on AMD is starting to feel decent again. Any thoughts on their current position and AI ramp up? Would love to hear your thoughts first, Neil.
Yeah, so AMD, I became a shareholder more recently. So I have, for those interested in the semiconductor industry, I have Intel, believe it or not, Micron, and AMD. AMD is the newest position in the portfolio. And I agree. It feels decent. Might have been felt decent for a while now, but it does seem like after DeepSeek, a company like AMD, in my opinion, shows that actually you might not need those super high-end chips from NVIDIA. And I think more recently, in the last couple of hours, I've seen a blog post by AMD itself. They compare the MI300 to the H200 when you use a DeepSeek R1, and the performance is not bad at all. And we're not talking about MI325 or 350 that's coming out in a couple of months, but MI300 compared to H200, which is quite promising. I think we had a couple of announcements as well last week. The UAE, France are going to invest, $40-60 billion in AI data center infrastructure. AMD was mentioned, I believe, in the press release. In Saudi Arabia, we've heard AMD's name as well. So I think Lisa Su's company is making some moves. And 2025, especially the back half of the year, could be when AMD starts to move more aggressively. MI350, and then starting in 2026, MI400, I think that's when things get quite interesting. Of course, ROCm, the software platform that competes with CUDA, will need to be much, much better. But so far, so good, I would say.
Yeah, I agree, Neil. I'm a big bull in NVIDIA. And I do believe the upcoming Blackwell, which was already now, this GB200 NVL72 system is going to be a monster when it comes to inferencing. But I think AMD, one of the things that got me really bullish for the stock right now, Neil, is you kind of touched it, is they are pulling ahead their schedule on the MI350. The MI350 was expected to come out in the second half of this year. Now they're saying mid this year instead. So maybe they're pulling it ahead about 3 months, three months ahead of schedule. And the main reason, Neil, right, they shared during their earnings call was they are seeing more positive reaction from both old cloud server providers and new cloud server providers. And in terms of these big cloud server providers, I would say the only reason, in my opinion, now that this is just my speculations, Neil, for you to pull up, it has to be because you're seeing a net new big customer. It's not going to be like a small tier 3 cloud server provider. It has to be one of the top players, one of the top 3 being Amazon, Google, and Microsoft that might be really liking the MI350. And for those that are not familiar, the MI300 right now in forms of the top 3 is only available in one, and that is Microsoft. Google did not want the MI300, and Amazon did not want the MI300. But if they're pulling ahead of schedule, Neil, I'm going to guess one of those two, if it's both, that would be insane, but at least one of those two is really liking this product, and that could be a very, very big wallet spender for AMD. And for AMD, even an extra $1 billion or $2 billion per year, not per quarter, is something that can change the overall financials numbers of that business. So I've said it a lot, Neil. I don't think it's the next NVIDIA, but the growth opportunity is definitely there. And I agree with 307 that right now, in forms of risk to reward, it's pretty up there.
No, I agree. And like you said, I mean, $1 billion last year, 2024, they, let's call it, generated just over $5 billion in AI revenue. So $1 billion extra is another 20%. I mean, $2 billion extra, that just becomes bigger and bigger because they start from a smaller base. So yeah, it would make sense. And we just talked about Microsoft, Amazon, and Google, but we know that Meta, for example, is a big user of AMD's chips as well. So it's going to be quite interesting.
Yeah, and then outside of the AI, right, Neil, they're doing really good. They mentioned that they expect growth this fiscal. They expect growth this year in the gaming side and in the embedded side. They say modest growth. So at any form of growth in those markets, it kind of shows that maybe the bottom is in for those markets, especially the embedded, which is a huge cash flow machine for them. And then again, growth in the AI PC market, the consumer PCs, and growth into data center CPU as well. So there's definitely a nice amount of tailwinds. But I believe, Neil, just one final point, that AMD pretty much mentioned that they expect a stronger second half than the first half of this year.
Yeah, no, I agree. And I think I've seen a report, you've probably seen that as well, with regards to them selling parts of ZT Systems. I believe they're looking for up to $4 billion in AI servers to sell. That could also definitely help them.
Yeah. And to me, Neil, I guess I was shocked how much it was willing to sell that server business. I mean, we knew when they purchased that CT system that they didn't want to go into the actual server business. It's more kind of getting the talent of being able to become system integrated, which is very, very crucial. And they mentioned that they were going to sell off as soon as possible with that server making business and just keep kind of the engineering side. But $4 billion is definitely a nice amount of money. I don't know, Neil, if you know what was the actual acquisition of CT System. I don't think it's yet completed, but I do believe that I forget what was the cost that they were talking about of acquiring. Let me see if I can go. 4.9. Oh wow! So pretty much just $1 billion in acquiring that team. I don't think it's necessarily the worst deal ever.
No, especially not for the future potential revenue that can come in thanks to that acquisition.
You want to take a question here, Neil?
I think the the last one that came in with regards to XYZ, for those that are not familiar, XYZ, ticker symbol XYZ, was previously ticker symbol SQ, which was previously known as Square, which is today known as Block. So Vian asks here, is thesis intact with XYZ down 15% Friday with a lot of insider stock-based compensation? If shareholder, would you hold your position or dilute and look elsewhere? So of course, this is not personal financial advice. I was previously a shareholder of Block for quite a long time, actually. I'm not anymore. I am a shareholder of other fintech companies such as SoFi and PayPal. I mean, Block does seem like, if you compare Block to PayPal, for example, you look at Block and you say, okay, this is a faster growing company, and PayPal is a slow growth company, but a much more profitable one. And this last quarter for Block was a bit of a disappointment because, well, where is the huge growth that you would have expected from them? I think gross profit is expected to grow just 15% in this year, fiscal 2025, which, I mean, we've known that, I think, for a quarter or more. So the market was expecting a little bit more. Cash App monthly actives are also not growing. It's been a couple of quarters where that number just stayed at 57 million, not growing. If you compare it to Venmo, Venmo is growing and doing quite well on the monetization part now. So yeah, I mean, of course I'm biased because I own PayPal, but just PayPal with the new management, and I think there is also an investor day in the next 2 days or so, I think for me made more sense because profitable growth, I mean, when you're generating $6 billion in free cash flow and then buying all of your shares back, which I believe last year they bought, I mean, they generated $6-7 billion in free cash flow and they acquired $6 or $7 billion worth of shares is quite something. It becomes a big effect over the years. The magic of buybacks, I mean, is something. So with Block, I mean, execution is key. I always say that execution is key. I think a great company with not so good management can be a bad investment in the future. What do you think?
Yeah, you know, I always find it funny reading a question about Block or Square. I don't even know what's the name of it anymore, but with that XYZ, it's always like an example of something. But I don't own this market anymore. Neo, there was a time where I was kind of somewhat curious about the fintech space, but I don't have any more shares in the fintech market. And definitely, I saw the stock price reaction on Friday, but I haven't really covered earnings or anything. So not much I can add, Neil.
Okay, I think I saw from a while ago someone ask about new holdings because they also reported, I believe, Thursday, but I can't seem to find that question anymore. But yeah, new was also down 18% or so, still growing extremely rapidly. But I think the market didn't like the FX headwinds, which again, okay, happens if you are in Latin America and these things where you have to report in dollars. Plus, they also said that they want to expand in other markets, and maybe the market is like, you know what, maybe you should focus on your core market. Every time we hear companies about willing to expand outside of their core area, let's say, it's always uncertainty of whether or not you are going to be successful, whether it's just burning money. I think with new, I've been following the company for a while, management top class, execution top class. So I think we should give them the benefit of the doubt. I'm sorry,
Definitely.
I couldn't find the question.
I want to take this question now, Neil, about 19 minutes ago from ProShop Guy. ProShop mentioned that they're reading various articles about conflicting supplier reports on the rollout of the new NVIDIA GPUs, aka the Blackwell platform. Many are pointing to a second half stronger performance thoughts. So one of the biggest conflicting reports, Neil, in my opinion, was probably Supermicro. So Supermicro reduced their guidance for fiscal year of 2025, which I believe only has, they're now in quarter 3. So they're about 2 quarters ahead of calendar year. And the reason they reduced their fiscal year guidance is they blamed it on new technology rollout. The only new technology rollout that would really make a huge impact in their revenue would be an NVIDIA product. So we are hearing reports that the Blackwell saw a bit of a delays, and maybe Supermicro is getting maybe a little bit hit a little bit harder than some of the other players. And Supermicro mentions that the B200, which is kind of the replacement of the H100 or the H200, are in full production on their end. Unfortunately, the system that they really, really wanted to be up and running, and in my opinion, it would have been a big winner for Supermicro, was the GB200 NVL72 system. The reason, I believe this would have been really big for Supermicro, and they kind of really over-prepared for it, is because this was one of those systems that was pretty much liquid cooled only. And this is something that Supermicro mentions in their presentations, that there's something they're really good at it. And not only are they really good at it, they also have the production capacity for it, which is a little bit better than some of the other players right now. And that's where they're seeing that weakness in the GB200. In their most recent earnings from NVIDIA, I actually was just reading it. They mentioned that the Blackwell production last quarter was better than the visibility that they saw was better than expected. And they were even increasing kind of their internal guidance on the several billions of dollars in Blackwell GPUs. So I think we're still in line with what NVIDIA was expecting. I think maybe Supermicro's comments and what we're seeing with Supermicro might not necessarily, Neil, in my opinion, be a picture of the overall market, because the GB200 is a very, very expensive system. This is that system that's expected to be at least $1.5+ million. I've even heard maybe closer to $2 million. And this is really going to be for heavy training and heavy inferencing. I personally believe that NVIDIA sent the GB200s out to the major cloud server providers at first, because those are the ones that are really going to be using it. And like the second line of volume production is being sent out to kind of like the Supermicros of the world. But I think their bigger customers are ramping up. We saw Google show the GB200, and I forget somebody else has also shown that the GB200 is up and running. So I wouldn't really be too worried about any delays from the Blackwell platform right now.
Oh, and while you were talking, I was searching something, and because I read this today, and it's their competitor. It's SMCI's main competitor, HPE. They were the one. The headline says here, HP ships first Blackwell-based AI computing system, the GB200 NVL72. So, yeah, quite a conflicting things here. What SMCI says, and then their main competitor, or one of their main competitors, ships out the GB200. So I guess I'll believe NVIDIA over SMCI for now.
Yeah, and it's not just, luckily for, I want to say Supermicro also might have some other evidence, or you might have some other evidence that might correlate with Supermicro. I remember Amazon during their earnings call mentioned that one of the reasons, that their capacity didn't grow as expected is because third-party accelerators were taking a little bit longer to kind of show the yields that were needed when building the servers. And for Amazon, the only real third-party AI accelerator that they get from is NVIDIA GPUs. So it's really weird. Like ProShop mentioned, a lot of mixed signals, but I think I'm seeing more positive signals than negative signals at the moment.
I agree. What are you expecting? Let's maybe go there in the meantime. What are you expecting from NVIDIA on Wednesday?
So on Wednesday, I think they guided about $37.5 billion. That's what they guided for this upcoming quarter. Analyst expectations, if I remember, Neil, and luckily I just kind of did an article about it here on the Fool platform, so this is why I kind of remembered it. For this upcoming quarter, analysts on average are expecting about $38.1 billion. On the high end, Neil, the most bullish analyst for NVIDIA is expecting $42 billion this quarter. I personally don't think 42 is possible, because the main reason is there is some form of roof for NVIDIA's revenue right now because of the capacity constraints happening in TSMC. And historically, we're seeing about a 4 to 5 billion quarter-over-quarter growth. So on my estimates, I believe we're going to be closer to like $38.5 to $39.5 billion in revenue this quarter. So I do believe we're going to beat analyst expectations on the average or the overall consensus. I don't believe we're going to get to that high end unless TSMC magically builds some manufacturing advanced packaging solution facility in the past quarter or so that we haven't really heard about. But I think maybe if we get to 40 billion, not that great. I wouldn't be too surprised either. Now, with stock price reaction, I that one is a complete coin flip in my opinion.
Yeah, no, I think that one will just be about guidance, right? Well, what they're seeing for the rest of the year, maybe margins as well, because we've heard in the last earnings call something about a small margin hit, but that should get better towards the second half of the year. So yeah, I think, I mean, it's quite insane that we're talking here about a company that's worth what, $30 trillion and is still growing faster than a lot of these smaller companies on the market.
Yeah, I think on the average consensus, it would be like about a 72% year-over-year growth.
Not bad. Not bad.
Neil, Letter Writer has a pretty interesting question here. What is the best way to follow NVIDIA or AMD a little closer from a big picture standpoint? Blog, news sources, watching earnings call, especially you now being a new shareholder, Neil, of AMD, and we know you are also a shareholder of Intel. How do you kind of keep up with this market that's continuously evolving?
So, well, since we live in this type of space of innovation, of information and innovation as well, we basically look for it on a daily basis. So it's your Google News feed, Fool.com, lots of great writers there as well. Social media accounts from AMD or Intel or NVIDIA. Usually they have their own blogs. So following the blog, you follow the news. Following some key employees, engineers, whatnot, from those companies, they might tweet out something interesting. They tweet or they post on LinkedIn or whatnot. So you follow wherever you can. It's true that if you want the information, you really have to spend some time on the internet, right? Whether it's on social media, Google News feed, Fool, you have to gather all of those. But I think both of us do a good job in summarizing those things in the articles that we post.
Yeah, I agree, Neil. I mean, I think on the top level picture, earnings call is definitely great in my opinion. And then just like understanding who are kind of their customers and try to hear what they say. We enjoy, even though maybe we might be shareholders of all the cloud service providers, I think we do listen to almost all their earnings call, right, Neil? Because it somehow impacts our thesis or thought process on either our AMDs, our Intels, or NVIDIA. So earnings call, I think, is a great. Another one, Neil, that I like to do a lot is CEO interviews outside of your traditional earnings call. And a lot of the CEOs right now have really gone to a lot of podcasts. I mean, we've seen Microsoft CEO just recently did a podcast, I forget, with Dakash Patel, I believe. I'm not familiar with the first name, but we've seen Microsoft CEO just do one. Like I mentioned, NVIDIA CEO just did a interview 2 days ago or 3 days ago. It came out. So YouTube and just Google kind of like the CEO you want to follow and discuss and just listen to them. I think sometimes they share some nuggets. They kind of maybe explain their thought process in the market a little bit better than they do through an earnings call, because in an earnings call right now, they only really want to focus more for what they see for investors and the financial numbers. These other interviews allow them to really show their true thought process. But again, Neil, like you mentioned, you have to be online a lot to be able to do that. And social medias, especially X right now, has helped me a lot in finding a lot of these sources outside of it. A lot of these YouTube videos, I sometimes find mainly first through X and then go to YouTube to check them out.
Yeah, no, I agree. I mean, podcasts has grown in the last couple of years, especially business. The business segment has grown immensely in the last couple of years, and I love it, right? We get to hear from the CEOs outside of the usual earnings calls, analyst conferences, and stuff like that. Like really talk business for an hour, 2 hours. I mean, on the Lex Friedman, we talked about semis and stuff like that for 5 hours. So if you've got time for that, if you go on long walks, definitely check podcasts out for sure.
Neil, let's see. Do you see any question here? You want to tackle, Neil?
We have one from 3 minutes ago about Supermicro. They notched their 5th straight session of gains with great momentum of 60% growth and reaching $40 billion in sale by 2026. Any feedback? So remember that guidance can change, right? For fiscal 25, revenue should have been, what, $30 billion or something like that? And now it's a bit less, a couple of $1 billion short. Of course, if they can achieve fiscal 26 guidance of $40 billion, that's a great goal. But yeah, I mean, 2 days from now is the deadline. They have to file their missing SEC filings, right? The 10K from last August, the 10Qs. If they miss that deadline, they will get delisted. There is no extension. And when you get delisted, the stock doesn't go to zero. You just trade on OTC markets. So we'll see. Definitely great momentum. And I think it's because last time, which was funny enough, this already happened in 2018, they announced, I think a week or so before the deadline, that they were not going to file on time. So the fact that they did not say that just yet, maybe they'll file, I don't know, at the last second. It's like truly a cliffhanger right now.
Yeah, Neil, so for me, when I think of Supermicro, I think of Supermicro as a business very different from Supermicro, the stock. And I think there's certain times when investors kind of try to distinguish the two, maybe when valuations have run up too much, or maybe when things like right now are happening where while a business could be doing good and there be a real market, obviously we're seeing there is a real market in AI servers. I think the stock itself is pretty much trading as a trading vehicle and not as an investment vehicle for my style of investment, right? Maybe somebody else might think different, but for me, it looks more like a trading vehicle right now. It's one that is pretty much just moving on any potential news. And like you mentioned, just because there hasn't been any bad news, the market is perceiving that as good news, which to me doesn't really make sense. It seems like the market is just taking a gamble on this. If maybe, and the market right now always gives us opportunities when there's massive amount of risk in the stock. And this is that massive risk for Supermicro. But for me, this risk is not something I'm willing to kind of invest in with management, especially having done something similar to this or being what's the word? Accused of doing something like this a few years ago and then happening again now. It's just not my type of investment style, even if the risk or the reward kind of outweighs the risk potential. So I believe the market opportunity is there for AI servers. We're seeing it throughout the whole field, but it's just, for me, it's too much of a trading vehicle.
Okay, we can continue that topic because Ed asked here 6 minutes ago, or says basically, Dell never gets any love, any opinion, earnings this week. Of course, Dell also plays in that market. So any thoughts on Dell and why it doesn't get the same love as SMCR or maybe HP as well?
Yeah, I mean, I think Supermicro originally got the most love because it was pretty much, it was one of those main AI servers, I would say pure plays, where with Dell Technologies and even HP, I think HP just recently got this popularity this past quarter or so. But I think in forms of popularity before was Supermicro, than Dell, especially during last year's GTC event where Jensen Huang only mentioned Dell, right? I think that's when the true popularity came out for Dell, and then most recently with HPE. I think Dell doesn't get that love because you do have that other consumer plays with the PC market. The PC market is not as exciting right now as the AI server space. And it really shows kind of the competitive pressure in this market. And I think, this is why also we don't really enjoy this market too much. It's more of that hardware space with a lot of competition. Obviously, in these types of markets, there could be winners, but it's just not a style that I would like to invest on. But looking at Dell, I believe we're going to see continued growth on their AI server. I think we just got news, Neil, that there are rumors that xAI just signed another big deal with Dell to build another kind of massive supercomputer. So that might be some excitement during the Q&A session. And we have heard from AMD and Intel, at least for this quarter, that we did see some nice pickup in the PC market orders. So maybe that could be trickling down, that Dell might actually be seeing a nice amount of sales on their laptops and desktop market. So maybe you could see some growth potential there on this quarter.
Yeah, I agree, especially from the newly refreshed AMD announcement, because a couple of years ago, AMD tried to do the same thing, didn't really work out, but now I think they're probably going to push much harder than before.
Neil, do you think, I still feel like the CPU market is very, very competitive in the space between Intel and AMD. If there is a lead with one or the other, I don't think it's by much at the moment. But do you think Intel being in such a negative light right now is kind of causing the consumers to be more favorable for AMD, as you just keep hearing, oh, it's game over for Intel, oh, it's game over for this, even though in forms of CPU performance, at least for the client side, I don't really see much of a difference. But do you think that the current light that Intel is seeing might be causing them to lose market share, even though their technology is not truly lagging?
Could be, for sure, could be. I've watched a couple of channels on YouTube about gamers and PCs and stuff like that. And I think that in recent weeks and months, especially after that Arc GPU from Intel came out and the performance was quite good for the price that you're paying, I think there might be a switch, like maybe cheering for the underdog here, right? There's always that, people like an underdog, and I think Intel is that underdog at the moment. But yeah, for the newest CPUs,
how things have changed.
Yeah, exactly. How the turntables. If they can continue with the execution, because the most recent CPUs were quite good compared to AMD. The difference is definitely not as big as it was a couple of years ago. So we'll see. I know all of them are pushing for that AI PC marketing thing, right? AI PC this, AI PC that. Like we keep saying, I think the consumer just wants a PC that's, let's call it affordable, has good battery life, good performance. Everything else on top of it, if you sprinkle some AI PC magic on top, is fine. But we want performance, good price, and I think we'll be happy. So from a consumer's perspective, I think the more competition, the better, because then that will drive the prices down, especially when we talk about GPUs.
Yeah, definitely. I think the market has always, at least it's so funny, I feel like the consumer market has always, in the gaming world, has always kind of, understandably so, has always looked for a heavy competition in NVIDIA GPUs, just because, $2,000 for a GPU is insane. Even now they're like mid-tier or like in the 500s, where back then you probably were able to buy one for like $200-300. So definitely a huge increase, in the more competition in the space, the better for consumers in the long run.
Agreed. You asked me at the start of the stream what I've been following, what I've seen in the last week, and there was Alibaba's earnings report. I don't know if you followed that. But I mean, I went into 2025 with an Alibaba pick, a Chinese stock pick, because, well, I thought this would be the year, the contrarian trade. So far, so good. And to be honest, the quarter, we've seen cloud continue to accelerate, right? 30% growth year over year. And now we're seeing more talks about AI coming out of China with DeepSeek, maybe some investments from Alibaba in DeepSeek, Jack Ma coming back. So it's funny how sentiment can change pretty quickly, although, of course, Chinese stocks have been beaten down for quite a long time. But so far, so good. So I was pleasantly surprised with Alibaba's report last week or this week.
Neil, I'm curious. You kind of touched a little bit, but what did they talk a little bit about? Kind of like the DeepSeek thoughts and how it was impacting at least that side of the world. Obviously, they have a huge clouding market. And then another one, again, I don't know if you took the time, but one I would be curious is, did they talk a little bit about the chip market there in China? I know there's NVIDIA still is able to provide the H20. I believe Alibaba does kind of have their own chip design, and we are seeing kind of Huawei being a player in the AI market there. But just curious from you, Neil, if they might have touched anything within those markets.
So they did touch a little bit on DeepSeek, of course. But then again, they have their own Qwen model, I believe, which, I mean, a couple of weeks after DeepSeek came out, they came out with the report and said, look, we can actually beat that performance. So they did talk a little bit about that for sure. I can't tell you exactly what was said. Too many earnings reports and earnings transcript to read throughout the week. But the second part of the question, I don't think they talked about that. Or if they did, I must have missed it. But if there is another question you want to tackle, I can do a quick search and come back with that answer.
Yeah, if anything, maybe just curious about their cloud capacity. Like here in the United States right now, we've heard from Amazon, from all these big players, that cloud capacity is the main reason they might not be seeing the growth. They could see faster growth if they had more capacity. I wonder if it's the same thing in that part of the world where if they had more capacity in forms of just either GPUs or whatever, could they grow more in the clouding space?
Yeah, let me do a quick search.
Yeah, while you take a closer look at that, I'm going to see if I can find any questions I could tackle really quick. There was a question about a day ago from Larry for Card Poker. And I'm not sure who was during that live stream, but Larry wanted to know, does anybody follow A-Labs? If so, your opinions, please. So A-Labs, ticker ALAB, is a company known as Astera Labs. Now, Astera Labs got very popular this past 52 weeks, this past year or so, because they really are trying to kind of help out. They're in the AI space market, in the AI accelerator market. Now, from this 52-week low, the stock is still up about 105%. And that 52-week low, we kind of saw in September. Now, unfortunately, from its 52-week high, which was the peak that we saw in December, the stock is down 41%. So it definitely has seen quite a pullback. Now, Astera Labs, for me, is one of those companies that has high risk to high rewards. The main concept that they're trying to do is they're trying to help AI chip makers find a better way to communicate within the AI chips. So one of the things that NVIDIA does really well is they're able to talk with one GPU to another GPU at such a fast level that it allows that GPU to pretty much, those two GPUs to really much seem like one. And it's done really well with NVIDIA's NVL72 system, which allows 72 individual GPUs to act as one. And that is very, very crucial for things like AI inferencing, for things like AI training. Now, no other real player is able to kind of create solutions like that, and that is NVIDIA's NVL-Link. Now, that is the growth opportunity for Astera Labs, is trying to create the not open source, but kind of like a third-party approach that anybody can have their own NVL link for their AI accelerators, and it's one way to try to combat against NVIDIA's moat. But let me just take a quick look at their price to sales ratio. I believe this is still, even with the massive pull down, it's still trading at some crazy valuation. So price to sales ratios actually has obviously still crazy, pulled down to 28. But just in early January, early and late December, Neil, this was trading at a price to sales ratio of about 60. So that value, it definitely got a lot cheaper. I think now this is the time where I maybe want to take a closer look at this. And maybe I might start pulling out some more full articles on this specific company so we can all learn a little bit more about Astera Labs.
I mean, even at that plus 20 times price to sales is quite a premium, But touching back on the demand side of things, so they did say that they expect Cloud Intelligence Group revenue to continue to accelerate. So I guess there is a lot of demand and the supply is there. Plus, they also told us that around 60 to 70% of the new demand that they're seeing is now for inference. So quite interesting.
Yeah, very interesting. And I don't think anyone ever breaks it down. But I guess now I'm going to have to add Alibaba and kind of these other cloud providers outside of the United States for more research data point, as I would like to see, like, where are they seeing kind of that inference growth? Are they seeing it in kind of like the autonomous vehicle market? Are they what in the robotics market? Where are they really seeing this huge growth in space? So thanks, Neil, for that.
My pleasure. There was one question from Vihan here 31 minutes ago asking about how you build your positions on retirement accounts versus taxable accounts. What kind of picks you look for capital retirement accounts? I think you can answer this question better because I live outside of the US. I have no capital gains taxes as of right now. That will probably change a year from now. So the strategy is a bit different.
Yeah, Neil, I mean, I don't think I can share much here. I just really have, I mean, I try to max out my retirement accounts, but I also like to have money readily available to me. So I don't have no magic position secret that I normally do. It's just a little bit here, a little bit there. So I don't think I have any great insight here.
Okay. In the taxable account, do you usually put ETFs or individual stocks in that one?
You know, in both accounts, it's similar style stocks. I don't think it's any different. Okay. There's no change in any of them in forms of how I invested. If I speculative play, I wouldn't mind putting them in both account. Very similar to a safe play, I wouldn't mind putting them, or ETFs, I wouldn't mind putting them in either or account.
Makes sense.
Mia, there was also another question from Vihan. Do you just, maybe if you don't follow it, we can keep the question in there, but do you follow Paycom?
I looked at it a year ago when there was, I think the stock crashed because they launched a new product and it was cannibalizing another one that they had or something like that. But since then, I don't think I followed the company. I mean, even back then, I think it was a solid business. I did not look at it since then.
Yeah, there was a semiconductor question that just came out from Ron. So Ron, any thoughts on Monolithic Power Systems, ticker NPWR? Neil, is this one that you follow by any chance? I do, but I just want to see if you had any.
I do not. I've heard of it, but I do not follow it.
Yeah, so the name pretty much kind of gives us a little bit of an insight of what they provide in. So they're power systems. So they kind of, if you've ever looked at kind of like your motherboard, Neil, or chips kind of like your GPUs, you have a lot of different chips. Some of those chips there are working with handling the power and sending the right amount of power to the right type of system during boot up or when running or whatever. So it's helping control the power within the system so that system doesn't kind of blow up. So NPWR, one of the bullish things for last year, Neil, was NVIDIA was kind of designing their own motherboard as well with the GB200. Everything was kind of intact. The CPU, the GPU were pretty much soldered to kind of this board that they had pretty much designed. And with this design, they actually had chosen NPWR to kind of pick for a lot of their power solutions on that board. And that was a huge growth opportunity. Now it seems like NVIDIA for the upcoming GB300 and for the further systems, they might seem, based on reports that I'm reading, it seems like, hey, maybe us designing our own board isn't necessarily kind of like the best thing. Maybe we should allow more customization in happening here. And there might be other players that might be providing better solutions outside of NPWR. So I believe this news kind of came out in October-ish. And since then, the stock has dropped nearly 29% after really being a big winner over time. This is one of those stock, Neils, that tends to have like a nice dividend yield. There's not much of a grower outside kind of those random black swan events like we saw with NVIDIA. The growth opportunity here, Neil, is everything in the AI market. And everything in general needs more power as we go to electrification. You're going to need better power solutions. AI servers need more power than the previous generations. So there's that growth opportunity there. So that's kind of their growth opportunity on a top level approach. It's not a market that I see they have their own moat, and obviously their products have definitely showcased that they're better than others. But the moat, I say it's very thin, and one that I don't know if I would be excited to invest in. It's one that I would be worried, hey, are my competitors going to be able to take market share pretty quickly? Is there going to be major changes happening? And I feel like that risk eliminates maybe my excitement for the stock, but there's definitely growth opportunities for sure.
Interesting company. Interesting company.
Anything you saw, Neil, that you might want to tackle for the last question before we finish this hour?
We might finish it off with a question from William 3 hours ago about Nebius. I don't know if you've followed the company more closely more recently. They had an earnings report this week. So he said Nebius growth seems to be underlooked AI GPU cloud stock with a projected recurring revenue of $1 billion. That's the ARR, the projected number. I think it was between $750 and $1 billion projected for the year. So it's another neo cloud type of company. In my opinion, it's because it's from Europe, it might give you that European pick in the whole AI team here. If you want that, of course, they're also expanding in the United States. But for those that don't know, Nebius, they were listed again on the NASDAQ late in 2024, completely divested from the Russian entity, which was Yandex, which was previously known as the Google from Russia, now HQ in Amsterdam. It's still a great team with lots of experience, growing extremely quickly, of course, not profitable. We've also seen from the 13F filings, or if you've been following the NVIDIA news, you know that NVIDIA participated in a $700 million, well, part of that $700 million investment late 2024 for Nebius. So in that 13F that NVIDIA released, you've seen Nebius' name, and that's also why the stock has gone up a little bit more recently, which again is quite strange, right? We've talked about that before. It's quite strange because this is not new news. That's a funny one. It's one that we've known from December, but it's definitely one that I'm keeping an eye on very, very closely. Nebius, it's definitely growing extremely quickly. And we're only here talking about the core business, which is the cloud business. They have a couple of other things, and an autonomous play, one with data collection as well, and I believe an educational part of educating people about AI, teaching them stuff like that. So it's all part of the whole Nebius group company. But the main reason why someone would look at it and invest, it's probably because of the cloud segment.
Thanks for that, Neil. Yeah, I don't follow it too much, but I do want to say it's one that I want to add to a data point, right, Neil? Because just how I was curious with Alibaba, with how their clouding market is doing in China, I believe as an AI investor, it could help us understand how the AI market is doing in other parts of the world, like you mentioned, Europe based. So I think we talked about this early on private, and we talked about kind of like the GB300 and stuff like that. So yeah, want to keep a closer eye out for more data points.
Yeah, yeah, because they are of course huge customers from NVIDIA, so they gave us that H200, GB200, GB300 type of information. So it's always nice to hear those types of data points from different companies, and especially those that are also coming out of Europe.
Yeah. So I think this is the end of our hour, Neil, and appreciate the insight you provided, and appreciate the questions we got here on Slido. I think we will be signing out from YouTube. So thanks for those in YouTube, and for members, the show will continue on in just a few seconds. So stand tight.
Yeah, thank